Yes. Hi, I'm good. How are you?
Good. We have the SIC meeting, so if you wanna go on YouTube and then watch it.
Yeah, just
Yeah.
joined in.
Yeah, it's in 1 minute or so.
Okay.
Just wanna make sure everybody aware of the meeting.
Thank you.
And then the material, let me forward you the material of the meeting.
Okay.
Let me do that. Okay, thanks.
Off briefly.
Okay, great. All right, call the meeting to order. Can we take a roll call, please?
That's how we do. Planning Commissioner Stephanie Garcia Richard.
I'm here.
Treasurer Lauren Montoya.
Good morning, present.
Nick Tejas.
Present.
Catherine Allen.
Present.
John Bingaman.
Present.
Kelly O'Donnell.
Present.
Mary Roman.
Present.
7 in the affirmative. We have a quorum.
Okay, let's turn to the approval of the agenda. Is there a motion to approve the agenda? Approval of the agenda.
Mr. Chairman,
Yeah, Madam Treasurer.
quick question. How many does it take to have a quorum?
6, I believe.
Okay. I do have to jump off at 10 for a quick meeting and then I'll jump back in.
Okay, thanks so much. Are the other members on the phone able to remain with us for the duration?
This is Nick. I might have to jump off just for a little bit, depending on how long this meeting goes.
Okay, I don't think it'll be a particularly long meeting, but, yeah, we have 7, so I think we should be good for the 3 votes that we have. Oh, I see Secretary Props has joined us as well, so yeah, I think we should be good. Thanks, Treasurer.
Thank you. Motion to approve.
Approval of today's meeting agenda.
Okay, Member Allen, I think BE2 and Treasurer will take that as a second, if that works.
Yes, sir.
Okay, can we have a roll call vote, please?
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Lauren Montoya.
Yes.
DFA Secretary Wayne Ross.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell. Kelly O'Donnell.
Yes.
Mary Roman.
Yes.
That's 8 in the affirmative. Motion passes.
Okay, thank you very much. Next, we turn to 1C, the approval of the March 24th minutes. Is there a motion to approve the minutes from the March 24th meeting?
I move that the State Investment Council approve the draft meeting minutes from March 24th, 2026.
Okay, we have a motion, Member Allen. I will second that motion. Is there any discussion? Hearing none, do we have a roll call vote, please?
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Lauren Montoya.
Yes.
DFA Secretary Wayne Props.
Abstain.
Okay. Nick Tejas.
Abstain.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Mary Roman.
Yes.
That's 6 in the affirmative. Motion passes.
Okay. Now I'd like to recognize our State Investment Officer for the SIO remarks, item 2A.
Thank you very much, and good morning, Mr. Chair and council members. Just got a few quick updates for you this morning. The first is some great news. Our accounting team for years now has been understaffed, very strained, but we had 3 new members join our accounting team yesterday, and we have another accepted offer. So with that, we are going to be doubling the size of our accounting team. That is fantastic because unlike other allocator organizations, ours manages 14 different state funds, about 50 different client accounts, and they just do tremendous work. I really want to thank Brent and Tu and the rest of the team for really making sure that we didn't drop the ball at any point during this strained period where we were so understaffed, but really happy that we're now getting them the support that they need. As well, on the hiring front, our team has recently been doing some events in connection with colleges and universities. We participated in a couple of recruiting events at UNM, including a wonderful event last week that Treasurer Montoya put on. So we joined ERB, PARA, and the New Mexico Finance Authority for this recruiting event at UNM. We had quite a few students show up, and they were thrilled to get a chance to hear from us, talk to us about what future career in investment or finance or accounting looks like in New Mexico. And we already now are starting to interview some candidates who came out of that career fair at UNM. So I want to thank the treasurer for putting that great event on. We are also in the process of hiring our first ever intern. This is through a nationwide program called Girls Who Invest. And they set up a structured internship program and help provide the guidance for the intern along the way. We're also in the process of trying to recruit an intern for our accounting team through Santa Fe Public High Schools. And we're going to be working with New Mexico State University, UNM, and other universities to set up an internship recruitment program this fall to hopefully hire at least a couple of interns for next calendar year. We also launched our first public-facing newsletter in April. It was a strong initial launch. We had about 170 recipients for the inaugural issue. Previously, the only newsletter we'd done was the more internally focused one that you are all on the mailing list for. We've also been much more active on social media over the last 9 months, and we now have over 3,000 followers on LinkedIn, which is about 400% growth over the last 6 months. So really excited about that activity. I want to thank Charlie and Molly and Francesca and the team for doing that great work. And with that, Mr. Chair, happy to stand for any questions.
Any questions or discussion on the SIO briefing?
Chairman, I do.
Madam Treasurer?
John talked about it a little bit, but I wanted to personally thank all of them because it takes a lot of time and energy to do an event like that. It was huge. The students were thirsty for the information. We had an executive table afterwards, and everyone wanted to sit with Don and John and Charles. Greg was also a presenter, and it was really cool for everybody to see their personalities along with the skill sets that they bring to the table. I ended up at NMSU for another event on Wednesday, and many of those students came back just to tell me how much they enjoyed it and how much they were greatly appreciative for it. I think one of them was actually going to apply for an SIC job. And when I'm talking about the type of talent we have, one of these young women went to high school in 2 years. She went to college in 2 years, and now she's working on her master's degree, and she has a degree in finance and economics. And her personal story is that she had applied for 100 jobs in New Mexico. She only got 20 emails back. She only got 5 callbacks to interview, and then she never got called back to tell her why she didn't get the job or that she didn't get it. And so she was planning on going to Texas or Arizona. So I think the timing of doing some type of event like this is huge because we really want to keep our talent in New Mexico. Outmigration in New Mexico is very high. And so everyone partnering together for this collaborative effort was very greatly appreciated on my part. I know that Tom Lofton and his team also were at UNM on the 16th with the Lobo Investment Club, and those students were really excited about what they've been doing and working with them. So I know we have hardcore jobs to do, but pouring into our young people to make them feel equipped to do the work here is a great partnership. The last component is that I'm working with both universities, and I'm going to ask to tap into your all's team, including Para and ERB, to make sure that the curriculum that they're being taught aligns with what you're needing in the job force. And we're working with state personnel along with the universities to find a bridge of certification so that once they're an intern, if they decide that they're going to work with us and we decide we want them in that team, they can get a higher pay start off coming out because they'll already be equipped to do the job. So long story short, grateful, thankful, and I think it's good work.
Thank you very much. Fantastic. Any additional comments or questions? Okay, let's turn to our short staff briefing with Director Lofton and Director Dunn.
Good morning. So quick update from us. Markets and macro and geopolitical. So the ongoing Iran conflict, as we're all well aware, ceasefire began around April 8th. The strait remains closed. Ports are blocked by the US. The strait is seemingly blocked by Iran. There seems to be a limited desire by the administration to keep dropping bombs. So I think there is a desire to get that deal done. And the ceasefire just keeps getting extended. So that's, I think, a positive. But it will be a difficult deal to reach. Sometimes these deals take years to reach. But hopefully in the meantime, the ceasefire holds. The macro impacts from the conflict. So the IMF global forecasts have been a bit under pressure as a result of the conflict. Their inflation forecasts were for 2026 were less than 4% in January. Those have moved up to around 4.5% globally. Under a severe scenario, they thought those could reach close to 6%. Their GDP growth forecasts have come down modestly. They're holding around 3%. Under a severe scenario, they could see those declining to 2%. More broadly, macro data has actually been pretty solid. Manufacturing and business outlook surveys have been better than expected. Initial jobless claims have been holding pretty steady, so we haven't seen a big wave in layoffs. We have seen continued layoffs at the hyperscalers as they prioritize AI CapEx. I think they've been reluctant to say it's due to AI efficiency gains that are requiring them to have less people, but I have to imagine that's got to be part of it. Markets have reacted with heightened volatility, so we saw a correction of close to 10% as the conflict started. And as we approached that ceasefire and then the ceasefire came into place, we saw a really strong recovery. So the S&P is actually, from beginning to now, is actually up a little bit. In its MSCI All Country World ex-US index, so everything outside of the US has recovered, but not all the way back, so it's down a little bit. So that makes a lot of sense. One of the biggest drivers has been semiconductor stocks. So the Philadelphia Semiconductor Index, which is referred to as the SOX, that's a broad global index capturing a broad group of semiconductor stocks, is up 45% in the month of April. That's the strongest month since February of 2000, which is pretty interesting. So it's really interesting to see that the fundamental improvements of the underlying stocks have largely kept pace with the price move. So you've seen this big price move, but you haven't seen a big expansion in valuation. So we're seeing a real acceleration in demand for semiconductors. Obviously, that's driven by the AI CapEx bubble. There's a growing understanding or feeling that, or view that over time, the number of CPUs per GPUs right now it takes one CPU per 4 GPUs. So CPU is the central processing unit, GPU is the graphical processing unit. The GPU is NVIDIA. We all know about NVIDIA. Right now, that's a 1-to-4 ratio. They believe over time that's going to change to a 1-to-1 ratio. So that could double the CPU market over the next 5 years. So you've got this huge tailwind for semiconductor stocks in general, driven by the AI CapEx. Interestingly, McKinsey released a study recently where they're estimating what AI CapEx may look like by 2030. They're estimating close to $8 trillion. They compared it to the railroad CapEx boom of the late 1800s, which in today's dollars and relative to today's GDP would have been around 10 trillion. So this AI CapEx boom that we're experiencing right now is, by historical measures, it's approaching one of the biggest CapEx booms that we've experienced in, I wouldn't say recent history, but in history. And does anyone remember when the first transcontinental railroad was completed? What year? Tom, do you know?
Mid to late 1800s. We'll call it 1870.
Oh, close. I gave him the answer, but he still got it wrong. 1869.
Off by one.
So that was obviously a major catalyst for the Industrial Revolution. So, you know, all that to say, we're living in a time of like major change and technological evolution. So stay tuned. Tom.
Yeah, I would just say quickly on the, as far as the credit markets go, they largely reflect the strength that's happening in the equity markets at a high level right now. There was initial widening. That widening has been retraced. It shows through in the technicals as well. When you're better technicals to understand liquidity in the market, in the fixed income market is new issuance. New issuance is going quite strong right now, both the investment grade side as well as the lower high yield side. There's demand. There's new issuance. Credit spreads are tight by historical standards. With that said, probably from the council standpoint, I think the key thing that the council needs to really think about going forward, inflation and interest rates. Inflation, a lot of your broader measures are running 3%, close to 3% now, well above the 2% sort of benchmark. I think that has two implications going forward. One, that rates are going to likely stay higher for longer relative to what we were thinking as short as even 6 months ago. And then importantly, going forward, if with the energy markets currently stressed, as well as a lot of sticky other inflation measures going forward, it means that there's less of a chance for that Federal Reserve backstop that we've been accustomed to in the past, where the Fed can step in and lower rates to juice the economy. Going forward, they may not be able to because of sticky inflation. So we're not going to argue on that. So that's just something to think about going forward from just the policy rates and underlying things. With that said, what questions are
there? One other comment. Mary Roman asked us to comment on the UAE leading OPEC. So that just hit the news this morning or last night, I believe. So UAE is 3 to 4% of global production. And from what I've read so far, just in the last few minutes actually, they've been pushing to increase production, and OPEC has been holding them back. So what it could mean is the UAE increasing their production over time, and more supply, I think, would equate to potentially slightly lower prices. Don, I don't know if you have any thoughts on that.
Again, this just hit the news this morning, so we're keeping up, and so are our different market analytics. But so UAE is one of the third largest producers. The impact on OPEC itself could basically mean that there could be less stability in OPEC in order to stabilize market prices over time. So OPEC's been seen as a force that in various circumstances could come in and adjust the market relatively quickly. They do that through their excess spare capacity, which UAE is one of the big drivers of OPEC's overall spare capacity. They're the third largest producer in OPEC. But Greg's absolutely right. They've been pushing for increased production for a while now and have been unsatisfied with their inability to do that, and the Strait of Hormuz closure has exacerbated their tensions within OPEC. They have the benefit of being able to expand investment capacity across land in order to avoid the Strait of Hormuz, and they've been able to actually get exports out, unlike some of the other countries. And so by withdrawing from OPEC, they can now expand their investments to increase their production. And that investment will basically be through land transport capacity instead of trying to go through the strait itself. Long-term effects really depends. We're still waiting to get analysis from our variety of energy analytic sources. This is breaking news, so most of what they've said is it could have a long-term effect on OPEC's ability to sway market prices in the future. Though UAE, by increasing production, that's going to have to be taken into account the same way shale increased production from the US has to be taken into account into total market supply. So it could overall reduce the influence of OPEC for better or worse. But stay tuned. The more we learn about it, the more we'll share with you.
Okay, question from Member Allen.
More of a comment, you know, I'm always gonna ask about employment and AI and the impact. And we did a webinar 2 weeks ago to several experts on AI. There's 5 studies that have come out in the last, let's say, 3 months. McKinsey, Cotiviti, Anthropic, World Economic Forum, Goldman, all talking about the job displacement and the impact on the economy. And I just think we have to keep watching that. And the impact on their state. There's not enough retraining or reskilling of people. So some talk about it as being really a white collar employment disaster. And it's mostly gonna hit people fresh out of college, where the unemployment rate is right now 9%, maybe going to 30% by 2030, and that's when you have revolutions. Also, the women, disproportionately impacting women and also impacting the Gen Z generation. So I keep wanting us to watch that and watch the impact on the state, because I do think we're gonna have an impact on the economy. We sort of have this K economy going on, but there are gonna be a lot of people that were making a lot of money or expect to make a lot of money or not. So
Yeah, I believe it was one of the founders of Anthropic recently made a comment that he thought in 5 years, 50% of the entry level white collar jobs would be eliminated by AI efficiencies. Anecdotally, we just did a call with a University of Chicago professor who's now working with one of our quant managers in Chicago specifically on utilizing AI tools in their quant strategy. He said they're hiring less research assistants because they just don't need as many people because they're able to do more with AI. And it's right in the window of when my kids will be graduating college. So yes, I feel your angst.
And these studies are saying it's happening faster than they thought.
Yeah.
One thing I will recommend is everybody see, there's a new documentary out called The AI Doc. And it's in some movie theaters, but you can also stream it. And it's experts, including the CEOs of some of the major AI, and they're talking about the pros and cons of AI. Not everybody agrees AI is a terrific technology and it's going forward, but it's looking at some of the guardrails of it, so.
Yeah.
Remember, Alan, to your point, what we're seeing in really a lot of the stresses on the credit side is occurring in the bank loan market, syndicated bank loan market. And what we're seeing is that within the software space, about 80 to 90% have had maybe a 5 cents on the dollar deterioration in their value, and that's mostly vertical software. But then there's a smaller percent, there's about 10% that had a much larger impact on their value. They're down, 20, 30, 40 cents on the dollar. And that tends to be the engineering software companies. And in a higher rate environment, those companies are going to be distressed because they're going to have to refinance their capital at some point. So it all kind of fits.
Yeah, that whole software as a service industry right now is up and the agents are gonna take over.
Yeah.
Yeah. Anyway, I will always, I'm just concerned about that because I really am concerned about the economy and the impact on our young people and what are we doing in the state to make sure that we're equipping our young people with jobs and helping the, mid-career people find new jobs.
That's something we've discussed at SIC for our well, I call them junior members, so we'll call them junior members. How do we incorporate AI into their daily work life? Because we want to help them prepare for the future. We don't want to.
Yeah.
So question back for either of you about the Fed. I have lost track of who's being sued and where are we on that? So we have a new Fed chair coming in. Is that going to happen? What's your color on that, please?
So at this point, it looks like Warsh has the votes to become the new Fed chair. It's just a matter at this point if Powell decides to stay on the board afterwards, and that's an unknown at this point.
Given what you said about being, rock and hard place, I mean, this war has put us, now we're 2 months into this. So regardless of who's in that role, they don't have a lot of options.
They don't have a lot of options, and one thing that differentiates our central bank from non-US central banks, most non-US central banks, they have one priority, which is stable money value. Ours has two priorities: stable money and employment, which can further constrain them in their ability to not only fight inflation, but to be a backstop during maybe a harsh macroeconomic downturn. So it's a further constraint, it's a further differentiator.
Just to remember Alan's comments about employment, given what you just said, Director Lofton, I want to applaud you for anything we're doing to help students, because this is not about pay for 4 years of college and then get a job anymore. It's the universities are going to face great pressure, and you can't train your way fast enough to meet what's happening here. So anything we can do as a state that helps people prepare to come out of college like a 30-year-old rather than a newbie at 22 or so is great, the state level.
Any additional comments, questions, discussion on our staff briefing? Anything on the phone? Hey, hearing none, thank you very much. The briefing, let's turn to our performance report with Mr. Carpenito and RDK.
Good morning. We're presenting the performance report for February. Just as a reminder, this is a public market update only. Next month, we'll have the quarterly report for year end. That will include all of the private markets as well. There's a little bit of a longer delay at year end as our funds undergo audits. And so that typical 2 month delay is more like 4 months. Also just wanted to update you a little bit on some of the things that we're working on with Arley Coons. We've connected them with our third-party fund administrator for all of our private asset classes, and the hope is that at some point in the future, having some of the private market specific metrics be included in their performance reporting. So that, you know, essentially you can have everything in one report and not have to, you know, look to 4 or 5 different reports or separate consultant reports, things like that. The other thing is RBK is also working on some more granular performance attribution for the public markets, and so hopefully we'll be able to include some of that in future reports. With that, I'll turn it over to Matthias.
Great. Thank you, Mr. Chair. Good morning, everyone. Yes, lots of work underway in terms of trying to provide you more actionable information, not just more information, but really an emphasis on what is most important for you all to know to make informed decisions in as much of a consolidated report as possible. As Nino already mentioned, we do have the February materials in your packet that's starting on page 16 that you have up there with economic indicators. You have a great report by both of your directors, Don and Lofton. And so I don't want to belabor some of the points, but maybe just try to put some of those things into context that you see here. Some of the reporting pages have been updated and are continuously being improved. So I just want to make sure that the data that you see there is known to you. One of the things under the economic indicators is a rank number. I think there was a question in a prior meeting around what does that number mean, and a low rank, so a rank of 1 is a low value, rank of 100 is a high value, and that value is relative to a 20-year history. So for example, when you see at the very top line US GDP growth of 0.7, that ranks in the 22nd percentile relative to the 20-year history, and you can see that 20-year number at the very far right-hand side, that ranks in the 22nd percentile. So that's a rather low number relative to what we typically expect, and GDP growth typically is north of 2%. But we've talked about some of the current headwinds there. So I just wanted to provide you with that information. We've also at the bottom seen that Treasury yield curve for quite some time, I think, and seeing how that yield curve changes, the shape. Importantly, it was inverted for a long time. It's right-sized more in the near term, but also the rate movement probabilities by the Fed and how those are changing. And again, I think as was mentioned, anticipation of rate reductions in the near term have decreased. There is a greater expectations for rates to remain higher for longer. We could still see a rate decrease maybe closer to the end of this year, but the Fed is meeting tomorrow, and it's broadly expected that they're holding steady. So this more hawkish stance, I think, in light of what's happening, this push-pull dynamic within the markets. We've discussed some of that already in terms of combating inflation, but also ensuring full employment, and those are sometimes at odds, or most of the time at odds, is a delicate balance that they're trying to get right. So for most of these things, given some of the mixed signals as you're looking at these economic indicators, some positive, some negative, I think we'll continue to see a holding pattern for some time. So we've talked about the US consumer and how impactful that is to GDP growth. I think that's something we can't lose sight of. It's about 2/3 of that. We're not really seeing any cracks in the labor markets broadly, but again, I think some of the comments that Member Allen and others have made about really looking under the hood and seeing that even though a number of sub 5% might look good, how it impacts different age cohorts or different income brackets can be very, very different, and that has more than just economic impacts. That really has human impacts that I think are important to keep in mind. And so again, that unemployment rate is quite a bit higher as you look at those younger age cohorts, for example. And so that 5%, while it looks good at the broad aggregate level, there are some friction points. Same with the different sectors and how those have been impacted. Of course, there was a lot of overhiring through the pandemic, so you're seeing some right sizing there, and The tech sector, of course, is experiencing that. Other areas are, like healthcare, are still doing quite well. So again, just encourage us to sort of be mindful of the aggregate numbers, but understand that there's some nuances and subtleties within that. The US dollar has softened for quite some time. That's been a trend that we've talked about. That's had largely positive effects for the investment portfolio, and in particular, your non-dollar denominated assets within the portfolio. That's largely non-US equity, but also could be in other parts of the portfolio as that has right-sized. It's still elevated relative to long-term averages, and you can see that in that economic indicator table. It has been very beneficial. You might recall that last year non-US markets were up 30% or so, and 10% of that just came from the FX or the currency rate movement. So very, very impactful. I won't talk too much about the geopolitical events. I think that was covered well by your asset class directors. Obviously, things started well in the year until the last day of February when those airstrikes on Iran happened, and that had a massive impact on the energy markets. Oil shot up above 100%, and it's sort of seen volatility since then. I think that the key takeaway is, even though March repriced largely, April, when you look at it on a year-to-date basis, has regained all that, and then some. We're really back in the plus through essentially this week. And so when you look at 2026, call it through either Friday or yesterday, we're up for US large cap about 5%, same with developed non-US about 5%, emerging markets up 15%, and bonds are flat to 1%. So things have stabilized a little bit, but again, could change very quickly based on the ongoing geopolitical tensions. And energy markets, I suspect, will continue to be volatile. And the announcement earlier this morning, I think it's just another sign of that. I will say that the way you've designed your portfolio, very well diversified, not betting on any one thing, emphasis on income, is well prepared to deal with this type of environment, and to continue to provide stability in that portfolio, given that you have lots of different factor exposures, as Lena was mentioning, and we'll begin to show you more of that detail to the degree that it helps inform your decision making. But just want to reiterate that I think you've built a thoughtful portfolio that will do well in this environment, and you've seen some of that already. Also very valuation aware. That's been helpful from your perspective of portfolio implementation. You have a little bit relative to the global market, more in non-US equities. That's benefited you. And so when you look at your global equity performance relative to the benchmark, you'll see that you're outpacing that by a healthy margin. So these things that you've built in structurally are all, I think, earning their keep. And so we don't have any concerns there, but obviously we'll need to continue to look at it. I will say volatility, while it feels uncomfortable in the moment, is also a good opportunity, particularly for a fund like yours that has such strong positive cash flow, to put money to work, to deploy capital, and take advantage of opportunities when they present themselves. Plans that have the opposite problem, that maybe are net cash flow negative, such as pension funds, they have to pay out despite volatility, even when markets are down. That's a very different situation. So you've got a lot of good things working in your favor. So with that, maybe I'll take you to page 19, just briefly here, a couple more comments. This is your asset allocation versus target across the different investment pools and funds that you have. Land-grant, severance, early childhood, these are listed by their size. And so those are some of the flagship funds, if you will. These three are the only ones that still have interim targets. We've made great progress in terms of getting there. But again, it's going to take some time to pace into your long-term private market targets. But I think you're making great headway there. And as you look at that, I sort of compared numbers. Where were you at the end of 2025? How much progress have you made? And I think you've made good, consistent progress there in terms of getting that capital deployed and more in line with those longer-term targets there. On page 22, Medicaid Trust, that is one of the newer funds. I'll just point out that at the end of 2025, so just a few months ago, that was 100% in cash. And you can see you've made great strides in terms of getting that deployed and allocated more in line with the long-term targets. Page 24, that's your cash flow schedule of investable assets, essentially seeing both the performance as well as the cash flow profile, largely cash flow positive, as I mentioned. Most of the cash flow, both the contributions and the distributions, occur both in land grant and severance, the two main funds. And you can see that your net cash flow is $842 million for the calendar year to date, with a gain of $2 billion and an ending market value of 72, almost and a half. So very, very strong. The return somewhere around 3% for most of the funds that have longer term allocations. Those that are more fixed income or yield oriented, a bit lower. You can see tax stabilization is an example of that, which has fixed income and real estate. That is up a little over 0.5% for those first couple months here. Then performance on page 26, pointing to the calendar year to date, fiscal year to date. So the third and fourth column there, I think you can see very stable results, positive, really across the board, outpacing benchmarks in nearly all cases. And then for the fiscal year, you're up almost 10% for those funds. So that's from July to February. The 1 year is even higher, getting into the mid-teens. So strong performance across those various funds. And then the last page, just of time here, is page 29. Again, we only have the public market composites, given that it's not a quarter end. And here you can see under the gray line, global equity composite, for the fiscal year to date, for example, 17.3 versus a benchmark, the equity IMI of 16.6, so 0.75% ahead. For the 1 year, even more so, and that, again, as I said, is sort of that relative positioning. You can see how those different regions, US equity and non-US equity, have performed. That's green and blue lines below that. And it's last year, certainly, or the trailing 1 year, big difference. 16.7% is a great return. Non-US equity put up 38%. So your positioning there in terms of really not just chasing the high flying stocks, but looking at where's their value long term is paying off. Public market fixed income up 4.5% for the fiscal year, a little over 6% for the 1 year. That's great. That's certainly a lot better than what we have seen. When you look out to the 10-year, 3%. Rates were so low for so long that fixed income just didn't matter. Now when you're getting 6% on an annual basis, that's not bad, and a lot of that's coming from income, so you don't have to really go out and take on a lot of credit risk to get there. Your portfolio, when you look at that, for example, that fiscal year to date, you see some slight underperformance, and that's mostly because you even have some conservatism built into that short duration, and so, but 4.5% is great. In cash, that's coming down some. You can see that, and I think that's maybe just the last thing I'll say. And again, your staff is working very hard to get capital deployed thoughtfully, but you are seeing, as the Fed has lowered rates over the course of the last year plus, you're seeing that those returns are going to be lower, and so that opportunity cost can start to increase. Certainly, if inflation were to move up, inflation still, as we heard from the asset class directors, range bound somewhere between 2.5% and 3%. But if that were to spike up above what you're getting on cash, then that starts eating into your purchasing power. So that's something that we'll of course keep an eye on and make sure to talk to you about. So with that, thanks for the time, and happy to take any questions and comments.
Thank you very much. Any questions on our performance report? Member Roman?
Mr. Chair, for Nino, what you had mentioned about third-party metrics is really exciting, because we should be able to, at some point in time, get much more granular in this portfolio.
Yeah.
Push a button and know exactly what our exposure is within an asset class to private credit has been a big thought of mine in recently and for all of us. So is that, it's really more for you, SIO Clark, is the timing of third metrics, when are we gonna be able to get that transparency of the lower levels of portfolio? We can see exactly what we own across asset classes at least, and then sectors within them.
So Mr. Chair and Member Roman, Nino has been really leading the charge on this effort. It's a 3-phase process to try to get that detailed look at our portfolio. We finished implementing the first phase. We're in the midst of doing some internal demos and starting contract negotiations to do phases 2 and 3 simultaneously, with a planned target to have them fully operational by the end of first quarter of next calendar year.
Great, okay. And then secondly, when does our interim indices on the 3 major funds, the first 3, become permanent indices? Is interim because of the pacing model that we're gonna talk about today? Is it the cash drag of we can't have it be our benchmark yet? Because funds are coming in so quickly that we can't deploy them.
Yeah, that's
Quickly
largely,
enough.
that's largely it.
Okay, so why did we have interim on 3 and not on the others? Because it's easier to deploy on the others?
I think it's a scaling issue mostly, that's where all the dollars are.
It's the size of the cash positions, so it's land, severance, and early childhood that have received the significant amounts of excess capital.
Okay.
Whereas the other funds being much smaller, that capital was easier to deploy. Whereas with the larger funds, those we're trying to make sure we get that paced out.
So the word interim is gonna be with us for a while.
Yes.
These cash, we're a finite portfolio.
Yeah, and those interims are there while we are trying to make progress toward that long-term strategic asset allocation. Whereas right now, if all of our benchmarks were based on that long-term strategic asset allocation, we could obviously, it's not a accurate comparison in a point in time because we're not near that strategic allocation. So our benchmarks would be based on 15% private equity and 15% private credit, et cetera, when we're at 7%, we're trying to pace out for private equity and
So we'd always be lagging.
exactly, so you try to get it into closer matching, and then as we slowly approach those interims, then we would start to adjust the interim targets, increase those. It allows us to officially adjust our benchmark so that we can make sure that we're performing as we would expect given the asset allocation we have today, while still trying to make progress toward those long-term targets.
Thank you.
Sure. Just back more on an economic questions and the comments you made earlier. On the oil, even if UAE, even if we have expanded oil, it still takes a delay, I think it's like 3 months before or more. So how's this gonna impact the economy for the rest of the year? If we don't get it, we already are seeing in Europe and in Asia, the jet fuel issue. And I'm worried about the delays in getting oil to countries and the impact that's gonna have on the economy and on inflation and stuff. So what does that really mean? Because what I hear or read in the press is even the tankers don't have oil in them that are coming to the United States that are not going to Europe. And if they do have oil, it's gonna be 3 or 4 months before that would be possible.
Yeah, I think you're right. I think there is a delay on the price increase side of things. That happens a lot quicker than on the price decrease side of things. I think from the economic perspective, when you look at it from the consumer, obviously that's a cost increase to their bottom line. I think in terms of having price stability for the consumer directly, that's part of their ongoing ability to participate in spending, but that's not the only driver. It's one of the more volatile ones. So when you look at, for example, we have it here on the CPI number, and I don't think it shows up in February yet, but I did look at it through March. So the headline versus core stripping out energy and food, that number is quite a bit different. So you're starting to see a gap there, but there's still lots of other components that factor into inflation that are gonna drive whether the consumer is healthy or not.
What about the airlines? I'm talking about also just impact on business because of lack of energy, or they can't get aluminum, or, I mean, and the delays in, even if the strait opened today completely, there's still a huge delay.
Yeah, there certainly is. There is an impact to the airline industry, but from what I've been seeing and reading is that demand is actually quite high. Again, I think it's changing who is flying and in what frequency, but demand actually seems rather strong despite the pricing having moved up quite a bit over the near term.
Again, I'm not talking, I understand the pricing part of it, I'm just, are they able to operate because they don't have the, whatever the materials are they need or the oil they need?
Yeah, I don't know that I can speak to that. I haven't seen any concerns that they wouldn't be able to operate, that there's a impending shortage for them to
But
do that.
in Europe it is, I mean, there's many flights that are already being canceled because they don't have the jet fuel or don't think they'll have the jet fuel on time.
Yeah.
Remember, Alan, we subscribe to deeper market energy market dives. Let me follow up with you after the fact, after the meeting, and see what kind of additional data and research we can get you specifically on airlines. I think it's a great thing for us to dig in more and some of the other items that you're talking about. So let me follow up with you offline on that.
And just, the top one of this is coming from, just a conference with third-party risk executives from 400 corporations, all who are very worried about this.
Yes.
And the impact that it's gonna have on operations, not just pricing.
There's a potential for very real supply shortages in that meantime, because if you think about an oil tanker moving across the entire ocean, right, and coming from the Strait of Hormuz, oil tankers move at quite literally the speed of a bicycle in terms of, nautical miles per hour. So they're slowly making their way across the ocean. You close down the strait, you still have tankers that were in the ocean that are making their way across. But when you start to see that supply shortages of the cutoff of oil tankers being able to make it out, you see those impacts most clearly in areas like Europe or areas close to the strait where those ships were going there. And then you start to see it more delayed once you're trying to get to places like the United States. So we're still seeing supplies coming in and just starting to notice a lot of those shortages and that gap. And then as we discussed, last month, the length and timing of that gap is really where you start to encounter the longer term supply issues. And how temporary it is whether or not you can deal with, or you can have either a temporary gap or being able to make up supply in other areas of the supply chain while you're trying to wait for the supply chain to correct entirely. But let's get you more detail on that, because I think digging into it more, now that we have really exceeded, there was the announced ceasefire, but a headline ceasefire doesn't change that the strait's still closed and that there isn't a lot of activity moving out of the Strait of Hormuz. And as we saw in our analytics last month saying that this strait being closed 6 to 8 weeks or more, that's when you could really start to see long-term damaging supply impacts. And so while there's been relative announcements of openings or ceasefire or maybe some sort of agreement, the fact is nothing's actually moving through the strait very much right now. And that will have a long-term impact on a variety of things. Like you were mentioning, there's fertilizer, there's aluminum, there's helium, there are not just oil. And all of that's gonna flow through to the economy and in differing ways and in differing segments of the global market. So let's get you some more detail on that and follow up.
Thank you.
I think we would all benefit from that.
We'll send it to the full council.
And I think that we of course look at it from a US point of view, because we're here. But there is a broader view. We're in a K economy here, so how it's hitting certain people is really really a problem. And it's always been absurd to me that CPI excludes food and energy, because that's what our the economy faces, but it would be helpful to know globally, especially with an oil-driven state like we are.
And again, we are all geopolitical. We may be in New Mexico, but you find out our businesses here are dependent upon components that are coming from all over the place, different places. So that the conference I was at, which I would say there's a lot of stress in there and looking at all different kinds of materials and components and things that are supply chain. And the belief was, I think the general belief is Australia is going to stay closed for some time. And so what are the alternatives and the impact on the economy?
And not only are we oil and gas dependent here, but we have potash development as well, so.
So it'd be interesting to see the longer term implications, because like you said, Don, if we were thinking this was gonna be temporary, today's month 2, end of month 2. And there's storage problems too. Iran can stop all the way, but where are they gonna put it? So that's another factor. So I think it's probably a good idea to do a deeper dive.
Absolutely.
Thank you, that would be helpful.
Okay, great discussion. Any additional questions, comments, discussion? Anyone on the phone? Okay, thank you very much. I will provide the investment committee report as we move into section 3 of our agenda. We did have a meeting last week of our committee. We reviewed the 2 investment voting items before the council today and unanimously moved to agreed to move those forward for the council's consideration with our recommendation. We also reviewed went through the pacing update they do here today and also a discussion on drawdowns that I think you'll hear in a subsequent meeting. We also reviewed some changes to the CIC charter. What did we decide on the timing of the CIC charter?
So, Mr. Chair, we're working on updating the charters for all 3 committees. The investment committee heard that one. The audit committee heard its charter yesterday, and then the governance committee is gonna review their charter. We're gonna plan to come back with all 3 to the council for the meeting.
Understood. Okay, so that's the investment committee report. Any questions or discussion on that? Okay, hearing none, let's turn to our first investment voting item of the day, which is LS Power Equity Partners 6 re-up. The director said.
And Mr. Chair, committee members, council members, just to note, because this is a re-up, we don't have the manager here in person to give a presentation, but they are available via Zoom in case there are any questions to come up.
I think the agreement was for these re-ups, we're not gonna have a manager presentation. We are gonna have questions. Council members can address questions to the manager if there are. Okay, with that, thank you so much, and let's get started on LS Power Equity Partners.
Thank you, Mr. Chair. We're here to recommend a $300 million re-up with LS Equity Partners. Joining me today from Mercer is Brigitte as usual, and then we have Darpan Kapadia and Emily Nonis from the GP online again for questions. This will be an increase in our allocation to LS Power from $250 million in the prior vintage to $300 million this time. From a diversification perspective, this will imply that the GP as a percentage of total SIC assets would be around 70 basis points. In terms of the real asset portfolio, fully loaded, that would be about 6.4% of that portfolio. LS Power has been operating since the 1990, specifically as a power and energy developer, with over 35 years of experience in more than 440 employees. LS has developed deep operating experience with core competencies in areas like asset optimization, revenue enhancement, policy advocacy, and strategic financing. These core competencies make them particularly adept at creating value through complexity, and their excellence in that area is reflected in an exceptionally strong track record. The LS Power equity team itself was formed in 2005 to access private capital markets and leverage the broader LS Power team. LS Power equity focuses on value add to opportunistic projects spanning renewables, conventional generation, and distributed energy resources. As I mentioned, they do have a compelling longer-term track record, and Fund 5, so the earlier vintage that we have been invested in is no exception to that. They have just finished their investment period and are currently marked at a 63% IRR and 1.37 multiple. An additional benefit of that strategy generally is that deployment has been very fast. They deploy most of the fund over the course of about a 3-year time frame. That has a tendency to mitigate J-curve, also positive development for the SIC's portfolio. Pipeline continues to be compelling with all the industry tailwinds that we're hearing about more broadly. And so we expect good things for this vintage. I'll wrap up there and hand off to Rajiv for his commentary.
Thank you, Keith. Thank you, Mr. Chair. Thank you, council members. Again, as Keith mentioned, we're here with Ellis Power, which again is an existing relation for the SIC. As Keith mentioned, the prior fund, Fund 5, the SIC committed $250 million. That investment is currently marked at a 1.37 net multiple and a 63% net IRR. Fund 6 is targeting roughly $4 billion. Again, the strategy is largely consistent with their prior funds and does have a value add / opportunistic risk profile, and will seek to invest in power and energy focused assets in North America. What we really like about this firm is that the leadership has been largely consistent, minimal turnover at the senior level. And what we also really like to see is increased and expanded employee ownership, which really increases alignment. The track record of their most recent funds, which we consider funds 3, 4, and 5, are what we view as most similar to Fund 6, have been very strong on both an absolute and relative basis. And all funds in the track record have above median distributions paid out. Now, the investment team that will be responsible for this fund is comprised of 32 individuals, and we view that team as well sized to not only manage Fund 6, but also manage the unrealized investments in the prior fund, which roughly turns into a ratio of 1.2 investments per investment team member. The GP commitment will be $200 million, roughly 5% of the fund size, far greater than what we typically see for similar fund strategies. As Keith mentioned, there are 3 main areas of focus. Will be conventional generation, so think gas-fired generation, renewable energy, which is solar, wind, hydro, and then distributed energy resources, the electrification infrastructure, microgrids, and whatnot. And again, as trends in power generation have progressed, the manager strategy has continued to evolve. So if you think back to their first fund, which was raised back in 2005, it was almost entirely invested in conventional generation, roughly 90%. And if we look at their most recent fund, it had a more minor allocation, roughly 40%. And of this, none of this was invested in coal-fired generation, only gas. The firm has an extensive track record dating back to 2005. They've committed over $11 billion across 5 funds. Again, strong performance. Every fund is in the first or second quartile. And again, as I mentioned, the manager's been consistent in delivering outsized distributions, which we view really highlights their ability to provide liquidity and exits across multiple cycles. So again, we are recommending a commitment of up to $300 million to Ellis Power 6. And as Steve mentioned, we do have the Ellis Power team on the line. And so ourselves or the Ellis Power team would be happy to answer any questions.
Thank you very much. Are there any questions on Ellis Power Equity Partners 6?
Mr. Chair.
Malone.
So we had such a robust discussion during the investment committee meeting last week, so I didn't bring this up then, but this whole weak key person clause, can't the manager think about adjusting that somehow so that all of their investors are not subject to what we are, which is the key man, key person risk? Does that come up in conversations with the manager?
Well, I think you, just to clarify the question, so yeah, that is something we pointed out in our analysis, that we do wish the key person was a bit stronger. The way we were able to mitigate that a bit is how much capital what we consider the most key individuals are fully committed to the fund. So it's less of a risk here than it would be if they weren't as, if that makes sense, fully aligned with where they are and how much of their personal capital they have committed. So that's how we got comfortable with it. Again, we'd still like to see a stronger key person because that protects our investors. But ultimately, in this case, because of their personal commitment to the fund, it's somewhat mitigated by that.
They do have a very large team with equity ownership planning over time, and that will increase the stable of people who could follow on. And so the processes are in place to build a strong succession should that become a necessary eventuality.
So this is something that's come up to them obviously before, because investors look at if two of the three key people left, regardless of the bench that's being built, that's still the key brain power behind the track record that we're buying into.
I think you find that they have an operating history since 1990, and that's been a team of some 400 people. Certainly, leadership is an important component in the overall performance, but I wouldn't underestimate the value that individual team members below there are contributing. So we're comfortable with it.
And this is exactly where that outsized GP commitment, that 5%, where we're used to seeing an industry standard of 2, is really helpful.
Thank you.
Any additional questions on LS Power? Any questions on the phone? None. Do you still want to make that motion?
Oh, yes, excuse me. I forgot, that's my duty.
If you would.
Yes, based on the recommendations of the Council Investment Committee, Advisor Mercer, and SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve a total commitment of $300 million to LS Power Equity Partners 6, subject to and contingent to New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, we have a motion from member Roman. Is there a second?
I second.
Second by member Allen. Is there any discussion on the motion? Hearing none, can we have a roll call vote, please?
Yes. Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura M. Montoya. I think she stepped down. DFA Secretary Wayne Props,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Mary Roman.
Yes.
That's 7 in the affirmative, motion passes.
Okay, thank you very much. We'll now move to another real assets opportunity, which is the SDC Digital Infrastructure Opportunity Fund 5. All right, recognize Director Sable to kick us off, please.
Thank you, Mr. Chair. Again, joining us for this presentation of SEC Digital Opportunities 25 from the GP are Todd Aaron, founding partner, Josh Birnbaum, partner for IR, and Todd Fiedler, who's been kind enough to join us from the data center and development operations team, which is a little bit of a different development for us at these meetings. I'm going to pause here and hand off to Rashid and ask him once he's made his comments to turn it back over to me.
Thank you, Keith. Thank you, Mr. Chair. Thank you, council members. Again, we're here with SDC Capital Partners. They're currently using SDC Digital Opportunity Fund 5, and they're targeting $3 billion and have raised $1.5 billion to date. Again, this is an opportunistic infrastructure fund. Since its inception in 2017, they've grown to manage nearly $9 billion of capital. The fund will seek to make investments across the digital infrastructure landscape, including data centers, fiber networks, and wireless assets across North America and Western Europe. The firm has an in-house engineering and development capability, which really provides an advantage when it comes to constructing assets and operational improvements. The data center investments that we'll be talking about today are fully built out from scratch, which includes land acquisition, site optimization, customer interaction, design, and then construction. As a result, SDC has built and maintained relationships with top-tier blue-chip counterparties, and these counterparties consistently reselect SDC for their data center needs. Now, Fund 5 will be largely focused on data centers, and this is largely driven by the global demand for data centers. The fund strategy is heavily focused on development, But the manager has a robust pipeline of 8 near-term deals, roughly $3.5 billion of total capital. 7 of the 8 are data center investments, and the pipeline is fairly split between North America and Western Europe. Again, SDC's track record dates back to 2017, with nearly $9 billion of assets under management across 31 transactions. The track record has been extremely strong with a pooled net IRR of nearly 41%. And while recent vintages are currently reporting low returns just due to the longer development process, none of the assets have been sold below cost, and all of the unrealized assets are on track to produce returns in line with or above their targets. With that, I'll pass it back to Keith.
Thank you. So to, I guess, recap real briefly, Harjeet's comments. One, we're seeking an allocation of up to $100 million for this fund. The firm is focused on development of data centers principally, and secondarily on adjacent digital assets and services. And SDC carries a tremendous track record. Having reiterated those comments, I'll acknowledge the elephant in the room, and that is we are talking about data centers, and it's a politically challenging topic. The reason we're talking about data centers today is in part due to the strong growth in digital spend that's anticipated over the course of the next couple of decades. There's a McKinsey report entitled The Infrastructure Moment that estimates $106 trillion will be spent on digital strategies over the course of time through 2040, or across infrastructure broadly, 19 trillion, which will be in the digital related strategy. So approximately 18% and change of global infrastructure spend will be in digital. The other key consideration when you think about this strategy today and how the strategy would fit into the portfolio is the fact that one of our existing managers will be returning about $140 million of data center related capital. That accounts for about 20% of our data center related exposure in the portfolio. And this $100 million commitment today would basically scratch the surface of replacing that capital without actually growing our exposure on a cost related basis. I think it's important to acknowledge council and public have legitimate concerns about the impact of data centers on the grid and in consumers. We look at the legacy tariff structures and we say that costs have been socialized, which is a bit of a euphemism to say that they're passed on to consumers. And those costs are generally out there to support the cost of new infrastructure, support increased demand for power. I think the world is changing a bit, and mega scalers would tell you that they believe fairness dictates that they should bear the costs related to the impacts that they cause. And this is a trend that is happening, I think, on a global basis. There's a concept called large energy user tariffs that have become fairly normalized in Europe. They're requiring that new large users are paying entirely the cost of their impact on the system. And I think that stateside, we're seeing some indications of traction on that topic. States like Virginia and Pennsylvania in particular are leaning forward in the saddle on that, and they are expected, based on either history or their access to natural gas resources, they will become significant data center hubs for this country over the course of the next couple of decades. So why are we talking about SDC specifically? Obviously, there's a really strong track record there, but more specifically about the strategy, we like the fact that it's development focused as opposed to collecting rents on essentially stabilized portfolios. Data center construction development is an extremely complex endeavor, and there's a lot of value to be added there by groups that are talented. We think this is one of the more talented groups in that space, and so we like their focus on development. We also think that, and this is a reflection of industry trend, that inference focused data centers will become a key priority and outgrow the training focused data centers over the course of the next couple of decades. That'll be a function of the demand put into the system from AI development over time. SDC is focused on inference-oriented data centers. Finally, tenant quality is a key consideration when you're thinking about trying to exit a position of data centers that you build. SDC is particularly focused on the highest credit quality megascalers in the system, and so we think that all is extremely positive. I think another reason why we're talking about SDC today, and perhaps more importantly, is because we do hear the concerns that are in the market about data centers more broadly. Gurjeet and I and about 10 of Todd's colleagues from SDC participated in a conference call that extended for something close to 2 hours a couple of weeks ago, and we delved into a number of corporate citizenship topics broadly defined, including water usage, site design, energy use, noise mitigation, labor sourcing, community engagement, and interaction with permitting processes more broadly. I can say these things in a straightforward way that I think it's far more effective if we have the GP provide some of those tangible examples that we discussed on our call. And so I would turn over to the SDC team to lead into some of those discussions.
Great. Well, thank you, Keith. Thank you all. We appreciate the opportunity to be with you today. By way of quick background, my name is Todd Aaron. I'm the founder and managing partner of SDC. Prior to starting SDC in 2017, I spent most of my career as a data center operator and entrepreneur, starting in 2001, 2002, repositioning legacy telco assets post.com bubble bursting for large enterprise co-location use. Grew that platform to become one of the largest at the time in the Eastern US, sold it to a public company in 2010, built a second data center platform, multi-asset platform over the next 6 or 7 years, and sold that to a different public data center REIT in 2017, and started SDC thereafter. So we'll talk in a minute about several of the topics that Keith touched on. Everything we do, certainly my perspective, is informed heavily by my last 25 years sort of living and breathing this space. With that, I'll hand it off to Dave to introduce himself.
Hi, I'm David Fiedler. Thanks for having us today. I started my career as an electrical engineer actually in data centers in 2007 when it was a growing nascent space, and since then I've held many positions throughout the ecosystem. Prior to joining SDC, I ran global data centers and network operations for Dropbox, and then I've been with SDC as a partner since 2019.
My name is Josh Berenbaum. Very thankful for being here today. I've worked with SDC for the past 5 years in-house. I've worked with SDC as head of IR and fundraising. I'm also a partner. I've worked actually with the firm since Fund 1 in 2017.
Great. So I thought what might be most helpful to sort of, again, expand upon some of Keith's comments, give you a bit more background specifically into what we're doing and why. Please feel free to interject with questions at any point in time. So to start and just kind of frame the lens through which we view the world, we think about the data center ecosystem really in 2 buckets, right? Those that are latency sensitive or for which the underlying uses are latency sensitive, that really being cloud computing and inference applications, as Keith alluded to, where actual users or businesses are interacting with these giant AI models. And then the second bucket is really more geographically agnostic facilities that are by and large hosting training for the large language models that underpin most of the AI applications today. We are very explicitly focused on the former. We, for a number of reasons that we can get into, believe that from an investment standpoint, there's greater residual value risk with respect to the latter. And for a host of reasons, we are focused on a smaller number of markets, generally in what are deemed sort of core more major metros, proximate to ultimate end users. Think Northern Virginia in the US, think markets like Frankfurt, Paris, London, in Europe. These are markets where we believe there is a sustained demand dynamic and increasing challenges in bringing supply to bear, and that's really where we think we have some unique capabilities. Everything that we do is on a single tenant bespoke basis. So we are not standardizing and trying to sort of crank out as many of these as we can all across the globe. We are very intentionally focused on a relatively small number of markets. And again, our model is really around engaging deeply with a large number of, we think, the highest quality counterparties, and designing and developing and operating what might look very different from site to site for those folks. Our model, again, is very much predicated on going deeper in a smaller number of markets. We're developing our 4th facility in Frankfurt, for example. We've developed several assets in Northern Virginia. The only way that we're able to do that on a repeated basis is to establish credibility with all of the relevant local stakeholders, local community members, obviously with our tenants as well. That is one of our, I think one of our core sort of values, and I think one of the things that differentiates us. We are central to every project of ours is in deep engagement with local stakeholders, with the community. If we're doing anything that is proximate to residential, we're not waiting for feedback. We're going to proactively hold open houses and meet with them. We're going to meet with the local political leaders. This is something that we have believed in deeply for several years. We have seen it, be enormously effective in just, being transparent, being upfront, and being straightforward. And the reality is, we found in most instances, when we ask people to articulate their sensitivities and concerns, we're able to address them. And it really is becoming enormously helpful in facilitating trust, and ultimately in facilitating our ability to do these projects. So I thought perhaps Dave can give one or two more specific examples just to give you some concrete evidence here.
Sure, and it's not a one size fits all. Every community has different wants and needs, and it's ultimately incumbent upon us to have that bilateral conversation where we're truly listening. And we believe that our ability to implement these changes really comes from a deep engineering foundation where we're able to find solutions that ultimately are able to produce win-win-wins for everyone. So, for example, in one of our Virginia projects, we have established a 500-foot no-build buffer adjacent to waterways, in addition to dedicating roughly about 19 acres of public parkland that include recreational activities, parks, trails, all of the above. And obviously that's critical for us to be involved in the local ecosystem. From a more technical perspective, we're thinking about how do we take things out of lines of sight? So we're burying sites. We're thinking about studio quality architecture. We're thinking about all of the noise abatements purely from a technocratic perspective. So how do I take a specific component and how do I, acoustically wrap it? How do I choose a frictionless compressor? All of these kinds of things are deep technical engineering topics, which I believe, are things that we're well equipped to implement. And I would also say that this cascades to both sides of the pond, where we are cross-pollinating and thinking about these, implementations.
So in Virginia, with the land use, you guys have talked about some pretty interesting work on wastewater and how you handle that situation. So maybe you could touch on that.
So one of the things that's critical, particularly in recharging soils, recharging aquifers, it's really critical to make sure that all of the storm water that's coming off of impervious cover buildings, things like that, comes down and, you know, is not just moving its way into the system. There has to be an element of cleaning that's involved. So we look to innovative methods like implementing things like bioswales that have multiple benefits, like establishing local fauna and local flora and fauna, in addition to removing phosphorus from all of the water that's coming off of these structures. So we're actually hopefully having a positive net impact to what would otherwise be just, you know, normal mandated code. So the whole concept is to take what is mandated and then do what's right for the community.
I think some of Dave's commentary also sort of alludes to one of our biggest differentiators, which is how we are structured, right? So we are sort of a mashup of an investment manager. We're structured like a traditional private equity investment manager, but we also insource all of the core development functions. We really look and feel to our counterparties more like a data center company. The contrast would be the more typical model where you have a private equity firm that is investing in a data center company that is then developing facilities. The benefits to doing it all together under one roof for us, we think, are multiple. One, certainly there are obvious economic benefits. We're removing an entire layer of economics, both on a cash and equity basis at the platform management level. We're also removing the necessity to acquire a platform, typically at a platform premium, to then have the right to invest in data center development. Our investors are participating solely in the development. They're coming in at cost day one, which we think is advantageous. Secondarily, you know, having our people, you know, first and foremost, managing all of the most impactful design, engineering, operational elements of these projects just gives us such better ability to be flexible, to be nimble, to be responsive to various stakeholders, obviously our tenants, but also to community members, to neighbors with perspectives. We have found, and as Dave said, this has been a dynamic that we have been able to translate geographically. We've been extremely active in core markets in Europe over the last several years, and I think this structural dynamic, which we think is quite different, has been a key attribute to our success.
So maybe back to David for a second, on the bioswale example.
Sure.
What would be the incremental cost of doing the bioswales versus a more traditional runoff management system? Why would you make that choice?
It just requires a little bit, it requires more technical awareness of the subject matter, candidly. I do think that there are some elements that get to, you know, earth movement, but ultimately, when you consider the entire budget of the project and consider that one element, it's almost imperceivable. So the reality is it's largely informed by engineering as opposed to something that's economically improbable, I guess.
And I would just add, we found that to be the case with, you know, so many elements, right? If to the extent there are concerns about noise, for example, right? The ability to, in the scheme of the budgets of these projects, adding incremental sound attenuation or whatever it might be, is really not a material cost driver. It's easy for us to do, and it's really just the process of engaging and listening and being able to provide feedback and not, you know, having to go through 4 channels of approvals to do so, I think has been a key driver of our success.
Yeah.
So on our call, we had a conversation about the permitting exercise. I think it was around Frankfurt, and I found that to be kind of an enlightening discussion about how you think about those processes more broadly. So maybe you could touch on that.
Sure. We have several projects in Frankfurt. I assume you're referring to what we call our Europort project, in which we had a dynamic where we didn't need to rezone a property to develop data centers. There was a right that existed under the German relevant zoning statute that enabled us to develop data center. But in engaging with the municipality, and in this case over multiple years, there was a desire for us to work through a more formal rezoning and more deeper engagement and partnership with the municipality. Again, we for us, that's a very simple calculus. We are playing a long game. We are trying to develop partnerships that we can leverage over, decades, ideally, not years. So, maybe we can talk about what that process entails in detail. It's a lot of work and a lot of effort, a lot of energy, but I think ultimately works.
And it follows the model of generally identifying all the stakeholders amongst any level, whether it's energy, whether it's zoning, whether it's density, these kinds of elements, engaging everyone and understanding the bigger playing field of what the mayor has to deal with. So when the mayor tells us that they are looking to develop the next generation of housing in his city, which has largely been non-existent, new housing has been non-existent. It's a very proud moment to be able to develop this, and as well to be able to participate from our front and develop new engineering techniques to provide waste heat from the facility to heat all of those individual apartments. That's something that we obviously say yes to, and it's something that requires quite a bit of technical engineering and getting into the how, and that is something we will always say yes to. And on other fronts, what we are always looking to do is embed ourselves visually into the community to sort of blend in, whereas the archetype is large concrete. From our perspective, we understand that there are new building techniques, including green facades where you're harvesting rainwater and using that to irrigate an entire green wall panel that's facing the community writ large. These kinds of things are things that we say yes to, that we engineer and we implement, and you can see them today.
So I guess another topic, or maybe the last topic that we should probably touch on is these projects are huge, require significant workforce flexibility. We had a pretty interesting discussion around to the overall picture, and so maybe you could talk about that.
Yeah, so I think it starts again with our specific business model, right? The facilities that we are developing, and the uses for which we are developing them for our tenants, they tend to deem as the most mission critical, right? These are serving revenue generating cloud customers, inference end users today. They're not sort of a means to an end of trying to develop applications for the future. And so, that informs a lot how our tenants and how we ultimately think about these projects. Obviously, schedules are always important, costs are always important, but we are not, they are not an absolute priority here. Quality is an absolute priority. Workplace safety in these projects, particularly when you're talking about very large scale, complicated construction sites, is a non-negotiable. It is something we spend an enormous amount of time and energy thinking about. And we work, exclusively with many of the largest contractors, subcontractors, many of which are union, especially with respect to the largest and most important trades, mechanical and electrical. And what we've actually seen over the years is in many cases, the efficiency and productivity gains often offset any cost deltas in those cases as well.
So I think we've done a fairly deep dive at this point. You may have questions that we haven't thought to address here. And so I guess I would open up the floor to questions.
And Mr. Chair, before we go to questions, if I could just add something, so, you know, Gurjeet and Keith and the SDC team did a great job talking about the market and very specifically why SDC, but thought it'd be helpful to provide members with just a few additional data points. So by the end of last year, data center facility construction had eclipsed both commercial office space development and renewable energy development in size. Bloomberg estimates the industry is going to see 23% growth this year, and a recent UN report estimates that worldwide, more than 1/5 of greenfield site development is due to data center development. So if we were to forego additional investment into this industry, we would be passing on one of the fastest growing industries. However, you know, because of the concerns that were noted, we are being very selective about what data center investments we bring forward. And I think the team and SDC did a wonderful job explaining why we brought you this one.
Thank you very much. Are there questions on the SDC opportunity from members? Member Owen?
Just a comment that to what SIO Clark is saying, you know, we have a major shift going on here that you've all lived through, which is infrastructure used to be airports and bridges and dams, and you didn't pay a lot of attention to. It also used to be funded by the government. So now we're going to, you know, cloud, whatever. I mean, all these terms are honestly very new to me. It's latency, inference, I mean, things that you've been trafficking in. So I just wanted to share with my colleagues here that we can't have an infrastructure portfolio without data centers. And I really appreciate how thoughtful you are with the communities. I mean, because this has turned into a covert operation in the United States. In our own state, it's a real problem. If we had you on the front end doing that, it's not massaging, you're actually building a relationship before you assume that the state or the municipality is with you. So that's very important. My only concern about the sector, and it's not relevant necessarily to you as a manager, but certainly you have a track record, is that the private equity firms are already in this game. Apollo already acquired Stream, Macquarie's already in there. You know, the players are already in. So when you have a mega scaler like them, when do they come to you? When they need that community involvement, when they can't get in there on their own? I'm just curious how that works.
Yeah, it's a good question. I think that what we talk about internally all the time is that our asset of greatest value is credibility, and it's really with everyone. I mean, in the case of the question you're asking, it's really with our tenants, and what they care most about. These projects are really complicated. They're getting really difficult. The markets in which we are operating are constrained. There are challenges in all directions, and really what they're relying on is can you do what you say you're gonna do? And at the end of the day, they honestly, I think, are less focused on, you know, who is the ultimate capital source behind them, whether, you know, it's this private equity firm or that one. You know, yes, there's been new capital sources, but the people on the ground actually doing the doing, it's a lot of, you know, familiar faces who've been around for a number of years, and I think that you know, those that have been around for a number of years are doing this, you know, have been successful because they have been able to prove that they can do these challenging projects.
So I don't know what our exposure is to data centers in the portfolio today. It's got to be
It's about 12%.
12%. And where do we want that to be?
I would say that's a work in progress. Generally, we're trying to build a portfolio with a starting point that looks like a broadly diversified infrastructure portfolio on a global basis. During the course of the structure study, we tried to roll out an initial look at that. Getting highly granular data on a global basis is not an easy exercise. I think the growth rate or the market share implied by that McKinsey research would suggest that 19% of the next couple of decades spend should be in that area, and we're starting from a small base, and so where these ratios would converge would be at something like that 19% digital over time, probably. But that will split out clearly between data centers and other digital adjacencies to data centers. Do you guys have a sense on what that market share for strictly data centers would be? I'm thinking something like half of that, so 10–12% is probably what the long-term norm would be. But we'll obviously have to grow that over time because the share will probably increase, and there's just a lot of capital to be deployed.
Additional questions, Member Allen?
Just several things, comments and questions. First of all, thank you to the staff for being so diligent in asking the issues around the community, because this is a huge and growing political issue and communications issue. Secondly, I applaud you all for what you're doing and how you're approaching this. And so a couple of suggestions, and you may be already doing this, is one is to look at developing a standard or code of conduct for the industry and being the leader in that and communicating that. So it's sending a message that you all are trying to be good corporate citizens and you're trying to bring along some of the other players. They may or may not play, but having that and having you communicate that, I think would be very helpful in all of the business stuff that's out there. And I think about it in 4 areas. I think of the water usage area, the electrical grid area, the heat area, which is becoming more of a problem. And then, as you said, the noise, light kind of area. I would even say somehow testing or looking to make sure there's no radiation or health impact in addition, but somehow trying to coalesce the industry or the players that would do that, I think, and then communicating that, not as a lobbying group to get, exempt from that, but on the good side of that, and then communicating that. And then I think we need to think about communicating that same thing of whatever our choices of that, because it is the future, and we do want to be investing in data centers, but what are our standards in how we're choosing where we make those investments, and maybe make that also public, because this is going to be a continual area. And I do believe there are corporations and entities that are good citizens, and you guys are doing that. So thank you.
Thank you. Additional questions or discussion?
I do, Chairman.
Yeah, Madam Treasurer on the phone.
So good morning, and I apologize. I came in late to the call because I had a different meeting. I know you've talked a lot about the differences in the data center portion. Did you all talk about the fiber aspect yet?
I don't think we've touched on fiber investments at this point.
Yeah,
if you could please discuss a little bit about that portion of it, what your process is, how you might be a little different or be proactive in some of the issues that are happening with fiber right now. I'd greatly appreciate it.
Sure. So quickly, there are 2 strategies around fiber in which we have made investments. One is very much data center adjacent. It is dark fiber data center interconnect, just sort of a mouthful, but this is developing and leasing large volumes of fiber, which the end users then light and manage themselves, interconnecting data centers principally in very dense data center clusters. Again, Northern Virginia, markets like that. The second is I would call fiber to the premise or fiber to the home strategy, in which we have through generally more traditional private equity type construct, although we've started several platforms from scratch as well, where we are building teams that are building new, state-of-the-art, latest generation fiber to individual homes and MDUs. We're doing that principally in secondary and tertiary markets where the population is generally, we believe, underserved by legacy telcos or legacy cable companies. I will say that on a relative basis, we see the opportunity set in data centers being so strong today that when we look at our pipeline, as Keith alluded to, our current Fund 4 that we are just wrapping up now, I think we expect to end up 85
90% data center. Our expectation for Fund 5 is that it'll likely be at least that, that type of percentage as well, could be higher. But those are some of our thoughts around 5.
Some of the questions that tails into an earlier discussion around use of union labor and quality of the work that they provide, so maybe you could just.
Yeah, I mean, it's a lot of our core, our core values and our ethos around data center development very much permeates what we do in fiber. So again, I think about some of our platforms, Allo, for example, which is active in Nebraska and Colorado. These companies are generally successful because they are hyper local and hyper engaged in their communities. That is, again, a set of values and attributes that we look for and we try hard to instill. And it's really simple, fundamental things, right? When, in contrast to, perhaps, large organizations that can make a mess when you're tearing up the street or, tearing up landscaping. If one of our platforms, one of our teams in doing a home install damages a shrub or a bush, they go to the door, they knock on the door, they say, "I'm terribly sorry that this happened. While we're with this, we're gonna be back tomorrow. What is this, what type of shrub was it?" That is how we think about, again, engagement, at the customer level, at the community level. And entering these new communities is similarly, a function of developing a relationship with the municipality, going in, sitting down with the mayor, and talking about how you can be a helpful partner and how you can help serve the community.
Thank you for that response. We've had, yes, to some degree, we've had quite a few issues with some of the other fiber companies using subcontractors, and they're not equipped or qualified to do the work, and it's causing actually a huge cost, more so than if they would have just gotten the union workers that were qualified to do the work to begin with. And it's also causing a lot of issues for elected officials whose neighbors are calling quite frequently, or potential liens on properties of over $1 million. That happened in New Mexico and Albuquerque. There's issues in Arizona and in California. And so I wanted to make sure that the way that you're doing business is something that is much more responsible, because of the fact that it doesn't just offer difficulty on the operational risk, but it also messes up rate of return. I wanted to also bring up another question that sort of was alarming. Your investment committee, this is page 80, correct? Is that's you all?
This is not our firm, no.
That's the prior treasurer. That's the prior folks.
Okay, just wanted to make sure. I'm glad I wasn't on the call for that one. You all resolved my questions for fiber and the data portion. I believe I heard most of what you all discussed on that end. And so I feel a lot more comfortable knowing that your process and how you're incorporating into the data center fiber infrastructure is a lot more responsible than what I've been seeing in the course of the last 3 years. So thank you.
Thank you very much. Did we have an additional question?
Just a quick question on this dark fiber. It sounds like a mysterious thing, but it really just means excess capacity.
What it really means is it's very low operational intensity.
Okay.
It means the opposite would be a lit fiber network, where you and your company is responsible for all of the networking infrastructure, everything that connects to the fiber, that lights and provides the network connectivity. Very different business, way more labor intensive, way more operational intensive. Dark fiber is really infrastructure. It's really just the core, strands of glass that are interconnecting facilities so that they can transmit data in large volumes back and forth.
Okay, thank you.
I just one question on exiting these assets. Are you typically looking to sell to like data center REITs? Are you selling to the tenants themselves, or like what are the two different options there?
It's a really good question and timely. We are seeing several pools of capital start to form now around
stable data centers. I put them generally in 3 or 4 buckets as far as those that we are seeing most active and to whom we expect to sell. There are, the largest institutional investment pools, think sort of sovereign wealth funds, think big global investors that are, as I think was alluded to earlier, are starting to pivot from some other real estate asset classes in which they've been more heavily invested historically and start to think about more core long-term data center type holdings. The second is particularly relevant, I think, in the US is insurance. Again, we think that, we haven't talked about this, but we are hyper-focused on structure of our leases. They all tend to be very long-term. We're very focused on trying to structure triple net leases. We're very focused on credit. Some of those align very well with how insurance companies look at the world and look to line up, those kinds of assets with long dated liabilities. The third would be public markets. There has been activity recently around some large platforms looking to build public vehicles to own stable assets, and we expect that will grow over time and will continue to be a source of exit capital. And then the last one, I think it's the sort of the private wealth, high net worth channel. Again, there have been large pools of capital formed that have also been active around this space.
Gotcha. Okay, thank you. Any additional final questions, thoughts? Is there a motion on this matter?
Yes, there is. Based on the recommendations of the CIC advisor, Mercer, and SIC staff and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of $100 million to SDC Digital Infrastructure Opportunity Fund 5, subject to and contingent upon New Mexico legal requirements, New Mexico SIC policies, negotiations of final terms and conditions, and completion of appropriate paperwork.
Okay, we have a motion.
I second.
And a second. Is there any discussion on the motion? Let's have a roll call vote, please.
Commissioner Stephanie Garcia Richard,
No.
Treasurer Laura Montoya,
Pass.
CFA Secretary Wayne Props,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
No.
Mary Roman.
Yes.
Back to you, Treasurer Montoya.
Yeah.
6 in the affirmative, motion passes.
Okay, thank you very much.
Thank you.
Thank you.
We'll now move, to item 3D, which is the 2026 SIC proxy voting policy. Recognize Ms. Chavez Romero, Deputy General Counsel.
Mr. Chair and members of the council, the proxy voting policy in your materials, starting on page 146 of the diligent materials, is provided in response to this council's and the governance committee's request to document considerations and policies used in proxy voting, and to clarify delegations of the council's role in reviewing matters subject to a proxy vote. The Governance Committee reviewed this policy at its March 23rd meeting, and this is a short policy divided into 4 sections that address a statement of purpose, voting requirements and considerations, delegations and authority, and monitoring and oversight. Sonia Ruiz at RBK conducted research and loaned her expertise in crafting this policy in collaboration with State Investment Council staff. And for that reason, I will now turn to Sonia for her comments on this policy.
Hello, everybody. Just a thumbs up if you guys can hear me. I know that you probably can't see me. Okay, great. Yeah, so I've been trying to troubleshoot my camera this morning, but it is not recognizing the built-in camera of my computer, so I'll fix that later. I do apologize. I even dressed up for you guys, but you'll have to enjoy that at a different time. Thank you very much. I'll make this brief. We went through a process of evaluating many different investment policies that have been written by your peers. We've looked at best practices and getting into more detail on proxy voting policies as they've gone under some extremely heightened scrutiny over the past 2 to 5 years, let's say. This is a great policy. It is not overly arduous. It just lays out it's a formalizing of a part of your governance. It's a part of your asset management. Proxy votes are assets that you own. So it's a formalization of that process. It's providing a lot of transparency to your beneficiaries, and it's really meant to just be a bolster to what your investment policy statement is. So the actual policy starts way in the back on page 146 if you wanted to look there if you're not already there. But we did get input from staff and from Amy, thank you very much. And so yeah, if I'm happy to take any questions, but this is we've gone over it, really strong policy. Again, it does not give up all of your rights to the asset managers. It still does retain a little bit of that case-by-case circumstances should you want to explore that. But it is altogether very concise, and I think it has really great coverage for what might come up over the next few years.
Thank you very much. Are we ready to move to questions?
Yes, Mr. Chair, if you'd like to have questions at this point, we could do that, or if you would like, I could go through the sections of the policy and summarize them briefly, whatever the council's pleasure is.
Maybe a brief summary would be helpful for members.
Sure.
Thank you.
All right, so section 1 includes an introduction and statement of purpose. This emphasizes that proxy voting rights are exercised consistent with the investment policy statement of the council and the state investment officer's fiduciary duty and the state investment council's fiduciary duty to act in the best interests of the fund's beneficiaries and to maximize long-term risk-adjusted returns of the funds. So in section 1 is just that broad statement of purpose. Section 2 deals with specific voting requirements and considerations. Section 2 specifically states that the NMSIC has delegated to the state investment officer the management of proxy voting on the New Mexico State Investment Council's behalf. But the state investment officer must direct investment managers and investment advisors to vote proxies on behalf of the council in accordance with the proxy voting policy. Each investment manager shall vote proxies solely in the best, or shall vote proxies in the best interests of best long-term economic interests of the fund. And this is tied to requirements in the investment policy statement of the State Investment Council. Proxy votes can be subject to various considerations, and you'll see those included on page 2 of the proxy voting policy, and they are listed out. One includes the fiduciary duty and long-term value and long-term economic interests of the beneficiaries. Another includes board accountability. The third includes executive compensation. The fourth includes shareholder rights and democracy. The fifth includes corporate governance, and the next includes sustainable investing in material ESG factors. All of these factors can be included in any proxy vote, and each one would be weighed on a case-by-case basis because it is difficult to ascertain which is more important in any specific vote. So this allows some flexibility when a proxy vote is under consideration, what matters the most and how these work together to support the best interests of the fund's beneficiaries. Additional considerations may include implementation costs, operational complexity, liquidity implications, and potential unintended consequences. And each evaluation must include a review of company-specific disclosures and peer performance, prior engagement outcomes, potential economic effects of the portfolio, and alignment with the policy's principles. Section 3 specifies how delegations of proxy voting are implemented. While the state investment officer is tasked with the management of proxy voting, the state investment officer and the council delegate proxy voting authority to portfolio securities for portfolio securities to the investment manager or investment advisor to be exercised in accordance with the investment managers or investment advisors' proxy voting policies, keeping in mind that this proxy voting policy would be deemed to govern in the event of any conflict. This policy also reserves on page 3 the authority for the council to evaluate, direct, or override proxy votes on a case-by-case basis. And it also specifies timelines for submitting information to the state investment officer for information gathering, or guidelines for timelines for submitting information to the SIO for information gathering and for notice to the public. Section 4 deals with monitoring and oversight, and it discusses the council's oversight of proxy voting practices. It includes reviewing an investment manager's and investment advisor's proxy voting policies and any material updates. It includes obtaining and reviewing summary reports of proxy votes cast on the council's behalf. And it also requires engagement with investment managers and investment advisors when voting practices don't appear to be consistent with their stated policies or the fund's investment objectives. Oversight activities must be conducted in a manner proportionate to portfolio exposure and the materiality of the issues under review.
Thank you very much for that helpful summary. Are there any questions on the proposed proxy voting policy? Any
Chairman.
questions or discussion on the phone, Madam Treasurer?
Yes, I just wanted to clarify everything that we already went through. They've already put in there, and I saw that it's italicized as well. So nothing else has been changed since the last time we spoke, correct?
That's correct, Madam Treasurer.
And I wanted to thank Sonia and Miss Amy for all the work that they did on this, because I think this got us to a pretty clear point. This allows for the council to take up matters when it's necessary to take them up, but it also gives a little bit of guidance to the people that are impacted by the proxy voting. And so thank you guys for the work and for working with our team to get this all done.
Yes, you're welcome.
Mr. Chair, this is Nick.
Yeah, Member Tejas.
Yeah, and I think the treasurer just kind of clarified what I was curious about in this policy. I just want to know to what extent does the council retain its interest and oversight in terms of proxy voting decisions, while the council shouldn't be making the decision on every single matter that comes up to proxy votes. There are occasions when we should step in and, perhaps have a vote to decide what we want to do with a certain matter. So what does that, how does that function within this policy, and to what level does the council retain its oversight right to proxy voting?
Member Tejas, the council is retaining its broad oversight right. There is a broad delegation of proxy voting responsibilities to the investment managers and investment advisors. However, on page 3, the reservation of the State Investment Council's right to evaluate, direct, or override proxy votes on a case-by-case basis maintains. So if the council wishes to step in and provide some input on a proxy vote, it retains that authority to do so.
And Mr.
Excellent.
Chair, Member Tejas, just to add to that, the policy recognizes that we may not always know far enough in advance when a proxy vote is going to occur for it to go through the traditional processes. So while the policy asks, if possible, for council members to provide the information to staff soon enough that it can get into packets for the investment committee to consider, it does not restrict the right for any council member to bring forward a proxy voting item to the council as long as we are still able to meet our Open Meetings Act
72 hours.
obligations. Yes, exactly, 72-hour notification, but it does not restrict any of your existing rights.
Yeah. And Member Tejas, this is the governance committee, we took this on and we had several meetings of discussion, and it's exactly to answer the question you just asked, which is what's the role that we play and can there be exceptions? When those exceptions could take place and what's the time period around it? So we all unanimously agreed that we thought this came, and especially based upon best practices that were done by other organizations. And so we really thoroughly discussed this and think this is really a good proxy statement.
Excellent. Sounds good. Thank you very much.
Any additional questions or comments? Hearing none, recognize Member Allen to make a motion on this matter.
Based on the recommendations of the Council Governance Committee, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council adopt its 2026 proxy voting policy as reviewed, discussed, and memorialized by the council today.
There's our motion. Is there a second?
I'll second if the treasurer doesn't want to.
Okay, we have a second from our land commissioner. Any discussion on the motion? We have a roll call vote, please.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Lauren Montoya,
Yes.
DFA Secretary Wayne Props,
Yes.
Rick Cass,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Barry Roman.
Yes.
Say the affirmative, motion passes.
Okay, thank you
And
very much.
again, thank you to RVK and Amy for all the great work you guys did on this and things together.
Great. You're welcome. Thanks very much, everybody. Appreciate the work and the help.
Got it done.
Okay, we will now move to an informational item, which is a pacing update. First Officer Carlino.
And Mr. Chair and members, you also have this presentation printed out in front of you in case you want to take a look at it in hard copy.
That's the same, it's the same.
Some of the charts are kind of hard to read on the screen, so there was a request for a hard copy.
So I've asked Dawn to help me with this presentation, as she's quite familiar with this process flow chart and can walk the council through this, as well as the energy transition scenarios and the differences between high and low and things of that nature. And then if there are questions as we go through with regard to contributions, distributions, capital calls, things like that, Dawn and her team thoroughly review all the capital calls and distributions, and so she'll be able to provide context if needed.
Absolutely. So we'll start off just on page 150, just to give everyone a brief reminder of how pacing fits into the rest of everything that we do. So last month we had a presentation around our oil and gas revenues, our inflow analysis, different scenarios for fund growth, and different scenarios for distributions to our beneficiaries. And if you'll recall, the primary way that we determine what do we think our future asset growth is going to be is based on those three key variables. What do we think inflows are going to be? So primarily from oil and gas revenues is where we get the biggest source of our revenues, but it could also be things like legislative appropriations or settlement payments for the opioid fund or the tobacco fund. We look at all the different sources that we expect to get in revenue, and that helps us determine how we have money coming in. Then we look at what are the capital market assumptions from RBK and how does that play into the total long-term expected compound return for each of our portfolios. So land, severance, early childhood, et cetera. What is that expected long-term return, which is driven by RBK's capital market assumptions for each asset class portfolio. And then we look at that portfolio based on its asset allocation and then pull together to figure out what do we think that long-term return would be. So then we grow those assets by that amount. And then also look at the distribution rates for each individual fund. Those are primarily set in statute. It could be 5% of a 5-year average or 5% of a 3-year average. Whatever that distribution rule is, we also bake that in. And those three things are going to help us figure out what do we think that long-term growth is. So when we say we think we'll get to 100 billion in less than 5 years, it's based on those inputs. The baseline scenario for inflows, and then capital market assumptions for fund growth and those distribution rules. Then we also look at a variety of scenarios, because if there's anything about assumptions, assumptions are always wrong. We want to be wrong for as little as possible. But what are the other things that could affect those different outcomes? And the biggest driver of differences is inflows, because they are so expected to be so large that big differences in those inflow scenarios could end up having us much higher than our original expectations or much lower than those baseline expectations. So we provide scenarios around that too to see where do we think fund growth might differ in that way. Now, what do we even do with that? And that's where this fund chart, this flow chart comes into play. The next step after determining what we think long-term asset growth is then how are we going to pace into those asset allocations? This helps us determine how well and how quickly and how fast do we think we can meet the asset allocation that was presented by this council, keeping in mind all of the different things that affect pacing that Nina is going to go into more detail. Once we are able to determine how do we think we can pace, that's really going to affect those next two items in this flow chart. The time we think that it will take to achieve those long-term targets that you all have set. And our ability to pace also determines where are we at in our actual asset allocation today. So today we're over allocated to fixed income. We're over allocated to cash. That's because we are pacing into the items for the long-term asset allocation. So that our ability to pace affects where we are today and how long we think it'll take us to get to the next stages. And then when Nina goes into more detail on how those energy transition scenarios affect our pacing analysis, just a quick reminder of what those transition scenarios are. So we have what we call our base case scenario. That is what the pacing data that you'll see today is based on. It's where that fund growth, our baseline expectation is, and to determine that base case, we say, what are the various inputs for oil and gas revenues over the next 3 years? So where do we think prices are going to be based on estimates from Rystad, Oxford Energy, just all of the current expectations now for oil prices and therefore production. We use that sort of 3-year variable range so we can get a good near-term look. And then we say for the long term, we are looking more at what inflows would be if prices were at least $60. We have reason to believe based on current market dynamics that we're likely to get at least $60 in WTI. And if we were to get at least 60 in WTI, this is where we think our inflows would be. What pegging to $60 allows us to do is not have to change our pacing expectation every single time the long-term forward expectation for prices changes a little. We want to know what the long-term outlook is for New Mexico oil, particularly if we were to meet those prices. We want to make sure that we think that that's actually still a reasonable expectation, that according to all the forecasts, at least 60 seems reasonable. If it doesn't, we would revisit that assumption. But it keeps our ability to pay and to plan more manageable over time. But we then want to see what are the range of outcomes for what those differences could be. And one of the big drivers of that is the energy transition. What that allows us to do is look at different price points on the high end and the low end, and different production points. So with very low prices, we would expect very low production. With very high prices, we would expect increased production. So we can take those considerations, plug those through the models, and see how would that affect our pacing analysis, and how would that change our forward outlook if we were to do that. Those scenarios are based on Rystad Energy's energy transition scenarios. They publish these scenarios every 6 months or so. So we at least update those scenarios every 6 months. And their house scenario is the most probable assumption for oil demand that they see reasonable in the long-term economic outlook and in global supply and demand. So if we said the most probable outcome based on current trajectories and trends in energy consumption, based on current adoption trends for things like electric vehicles, sustainable aviation fuel, plastic recycling, looking at the various stated policies from governments saying here's where we are wanting to go in terms of energy transition and energy mix for renewables versus non-renewables. And they base their house scenario on that as what they think the most probable outcome is. Then they produce a high scenario and a low scenario, which are again just probable ranges on each of those inputs. So probable ranges on assumptions for EV adoption, probable ranges on assumption for plastic recycling, or even things like plastic bans, probable ranges for development in sustainable aviation fuel, or even in helium development. So looking at a variety of different outcomes, and then trying to peg what those ranges could be. And then there's a fourth scenario you'll notice included in each of these, and it's called the 1.6 degree scenario. And what that's saying is this is how much oil demand would have to drop as of today. What would oil demand have to drop to in order to reduce, or in order to limit global warming to no more than 1.6 degrees? And that then says prices would need to drop, or demand would need to drop pretty significantly, prices would drop pretty significantly, therefore production would relatively plummet. And that gives us a reasonable, very low case. So we can kind of get a sense, at least on the inflow scenario piece, what that worst case scenario for, or that I wouldn't call it worst case, but I'd call it lowest case scenario for the amount of revenue that those funds would be getting. So best case scenario for the environment, when we're looking for inflows and how much revenue the fund gets, it then adjusts for what we would have to plan for in order to start making sure we can meet the same distribution requirements and beneficiary distribution requirements, and leaning more heavily toward things like investment return as opposed to relying on inflows for growth. So it gives us a sense of where those different dynamics lie. And we update those models each time it comes in, and we update this pacing data as often as we're able to update these models. So at least twice, if not 4 times a year, each quarter, so we can get a sense of where we are relative to where we thought we would be at the as of the last estimate. So with that intro, I'll turn it over to Nina.
Thank you, Dawn. Just want to make a few general comments on the model before we dig into the energy transition scenarios and the pacing analysis. The pacing model estimates the annual commitment needed to achieve the target allocation. It incorporates multiple inputs to project contributions, distributions, and net asset values. These are things like contribution rates, distribution rates, rates of return, cash yield, as well as fund-specific terms, things like the term of the fund, the investment period, possible extensions, things along those lines. As Don said, we update it with actual data as it becomes available. If those updates result in material changes, then we'll go ahead and we'll revise our plan going forward. By doing pacing internally, what that does is, not only affords us tremendous flexibility, but it also ensures that there's a consistent methodology that's being applied across the private asset classes. So the energy transition scenario analysis, Don went into that. Talking about the permanent fund net cash inflows, that's been kind of the driving force behind the increased commitments. So what we decided to do was to expand her analysis by incorporating it in the findings into the pacing model. And that produced a range of possible outcomes. The NMSIC base case, that serves as the default scenario that we use in the pacing model. On the next page, we see the energy transition scenario analysis. What I'd really like to do is go to the following page. So let's go ahead, and if we could just jump to 154. And what I'd like to do is so on the chart on the top right is net asset value. And so, the projections that Don's able to provide in terms of fund net asset values, that drives our commitment activity, and then everything else is driven by the commitment. And so if we take a look at that net asset value, and I can provide some numbers behind that. Let's see here we go. So she talked about the range of outcomes, and so here we're going to look from the high scenario to the low scenario. So when we're talking about net asset values, for the current year, very small. We're looking at roughly $658 million range. However, if we're looking at 2030, that range is 10 billion. And in 10 years, 2035, that range is just under 33 billion. And so just a very wide range. And those NAV projections, as I said, they flow into our commitment activity. And so when you take a look at commitment activity and the range there, for this year, you're looking at a range of about 2 billion. In 2030, you're looking at a range of about 4 billion. And then in 2035, you're looking at a range of about 11 billion. And so you can see just very wide ranges. And so it's very important for us to update these models as frequently as we can and as we get new information. Now I'd like to turn to page 155. This is the chart that I added from the CIC. And so essentially what we're looking at here is permanent fund net cash flow. And so you'll see contributions, distributions, and the total. Now, when we say contributions, we're talking about oil and gas inflows. When we talk about distributions, we're talking about payments to beneficiaries. And so one of the things that, and this is surprising to me as well in putting this together, is you see the catch up. And so you see that distributions are catching up to the higher net asset values, to the extent that you take a look towards the latter part of the 10-year look forward, and essentially you're looking at inflows offsetting distributions, and in some cases, it could also result in negative net cash flows. And so what that does is it puts a greater demand on our liquidity and for liquidity needs. And we've been fortunate that we've had the wind at our back for some time. That won't be the case forever. And at that point, you know, we'll have to, we'll have to, in terms of meeting our capital calls, we'll have to be more thoughtful in doing it, and perhaps even, that'll need to come from, it could come from reallocations from other private asset classes, or it could be funded by distributions. And, currently right now, I would say that anywhere from 50% to 2/3 of our capital calls are being offset by distributions.
And I'll just add one thing to this chart here. If you're looking at from say 2022 to now 2026, 2027, that big difference in the green versus the red, that green is the inflows we've had coming in, the money coming in the door. The red is the distribution out to the beneficiaries. This is a really good illustrative chart on why it's been difficult to meet our asset allocation right now, because we've had such significant inflows. We have a lot of this excess cash. We need to deploy it thoughtfully. Technically, we could find a way to deploy all of it this year. That wouldn't be wise or prudent. The opportunity sets may not be there. You have adverse selection issues with GPs. You could end up with imbalances or over allocations of risk that you're not necessarily prepared for in the asset allocation that you've already assigned. And so what this illustrates though is why that's been so difficult, but it also shows a trend toward, or an expectation toward, more normalization, where as those inflows start to level out based on our current baseline expectations, and our distributions begin to grow as our NAV grows, so our beneficiary payouts get larger, then we'll start to see that that net cash inflow, so that gray or that dotted black line, instead of being cash positive on that basis, will start to level out. Then we'll be looking at maintaining liquidity, as Nina was saying, through our capital calls and distributions from our private assets. We have income producing assets. Those will provide cash to the fund that allow us to fund our liquidity needs, in addition to being very thoughtful about our allocation demands, so that you may have to exchange low duration fixed income, which is part of the reason that it's there, in order to fund big distributions in July. Most of our distributions to beneficiaries are in July, but this is all part of capital management and liquidity management that hasn't needed to be front and center for this council or for the office, because of these big green bars right here, because of all of that additional excess liquidity that's been available. But as that starts to normalize, that will start to be a bigger issue. And then one of those things that the scenario analysis helps come into play is the timeline of which we start to have to think more seriously about that. So in the very low transition scenarios, these green bars would be much smaller, and therefore we'll have to start thinking about that liquidity picture much faster. Yep. And in the high scenarios, those green bars could end up being much larger for longer, and then we would still have to play catch up to our asset allocation.
So this includes the early childhood fund and the two permanent funds?
This includes all of the permanent funds.
Okay.
Yes.
Yeah. And let me just quantify some of those numbers. So if we take a look at total permanent fund net cash flows, they've been positive since 2019. And so from 2019 through the end of last year, the cumulative amount is $22 billion. The current projection is that, and that's 7 years, the current projection is that they'll remain positive for the next 8 years. And then the difference there would be an additional $10 billion. So they are slow, which I think gives us a realistic chance of achieving these target allocations within kind of the desired time frame. Not dealing with high double-digit year-over-year growth in the denominator. And now it's something more manageable, where it's a, single digit.
And then the last thing I'll point out before we move on from this chart is you'll notice the beginning of this from 2011 to roughly 2019, when we had that relative balance between inflows and outflows. What that tells you is, having to maintain liquidity for our private asset portfolios and for our general beneficiary distributions is not a new thing. It's not something that is foreign or unknown to the office or to the council. It's just not something that we've had to focus on in the last few years because of the inflow picture and just how much we've received especially since 2022. But really, this has been growing since 2019, as Nina's pointed out. But the comfort in that is that this is not something that is foreign to either the council or to the office. This is a regular thing of having to balance those inflows and outflows. And really, we're just showing that we think that we'll get back to that more normal scenario within the next decade, and that this picture of excess liquidity, at least according to current baseline estimates, and I'll always caveat with that, different things can happen. But according to the current baseline, we expect that this current scenario we're in of high net inflows relative to our outflows may not last very long. Should come to normalize within the next decade or so.
Thanks, Tom. So please, as we go through the basic analysis and the charts, keep this in mind. Because it's
You
highly.
can call that the SGR blip. It's literally like.
Right. Yeah, highly relevant to additional slides in the presentation. So if we turn to, now the next two pages go over commitments. And what I did here, and this is based on conversation that we had during the CIC, is I wanted to differentiate between commitment year and vintage year. Commitment year, we have control over when we commit capital. However, we do not have control as to when an investment manager begins investing. So if we take a look at, so the first page is by commitment year. And so if we take a look here, what we see is that commitments have nearly doubled in 3 of the last 4 years. Essentially, so 2023 to 2025, so the last 3 years, we've committed $21 billion in capital. The previous 12 years, going back to fund inception, we committed $20 billion. If we take a look at last year was a year where we significantly overcommitted within 2 asset classes, within private equity and real return. They were able to find an abundance of opportunities last year, and that's part of the advantage of doing this internally and having that flexibility to take advantage of the best opportunities when they present themselves. The current plan for this year is $6.5 billion. And then just to give you a little bit of perspective, that will increase to $9 billion in 2030. And then 2035, we're looking at $14 billion. So very large numbers, and honestly, given how large we're becoming, I think that size does work in your advantage up to a point. These strategies aren't all scalable. And certainly what we don't want to do is to have to compromise on manager quality. One of the things that we do internally is we take a look at vintage year performance dispersion, and we'll look at the interquartile range. And so essentially what that is the difference between the 25th percentile and the 75th percentile. So we're throwing out kind of the outliers and looking at that middle 50%. And what we found is that the average vintage year interquartile range for private equity, it's 1,600 basis points. And for private debt, that's on the high side, and then private debt is 800 basis points with real assets, somewhere in between. And that dispersion within a given vintage year is much larger than the dispersion across vintage years. And so, manager selection is really the best way for us to add value.
And adding on to that, Nino, and one of the things I think is a good takeaway for the council and to think about as we come up on our asset allocation study, as we bring you managers, as we bring you structure studies, and as we present these pacing analyses. One key question you may ask is saying, okay, if prior to 2023, we were committing $3 billion, less than $3 billion a year in private assets. We've now ramped that up. Could we, in order to achieve our asset allocation and with all this additional cash and the growth in the denominator, we've been able to grow those commitments to $6 billion. So your question may be, well, can we prudently and with good managers increase our commitments to $6 billion? That's what we've been bringing you. We think we've found good, high quality managers. We think we've been able to keep up with that. But your next question may be, in order to maintain this asset allocation, just the asset allocation it is with the expected NAV, by 2035, we need to be able to find $14 billion of good, high quality private asset class commitments. Can we do that? And that's a fair, reasonable question for this council to ask and to be asking every time we bring in an asset allocation in order to tie your asset allocation study to the practical implications of what it takes to implement and get to that asset allocation. This is what the pacing analysis ties in for you. It's saying this is what we need to do in order to get to the asset allocation you've set. Is that reasonable? Can we do that? What are the metrics that we're evaluating ourselves on? And are there alternatives if we don't think for some reason that we can feasibly commit $14 billion a year in 10 years in private asset classes? What are the other considerations that we need to have? So these are all questions that we're asking internally. They're all questions we expect would be asked by the council as well. And we look forward to being partners with you in figuring out how we address this. How do we get to the asset allocation that you've set? And this is part of us demonstrating to you, just on our base case, what it would take to get there. And then us being able to together take a step back and saying, is that feasible? Is that reasonable? Can we achieve this? Can we maintain it? Can we do it prudently? And if so, how are we doing that? And if not, what kind of changes do we need to make?
Yeah, those are great points. I mean, I'm reminded by a quote from Dave Swenson, who's the father of the endowment model, and just kind of talking about, if you can't develop relationships with and obtain capacity with the top managers, first and second quartile managers, there's no reason to even do it because you just get eaten up in fees. You're better off doing some type of alternative. And one other thing to point out also, as you look at this chart, and we'll get into this a little bit later as we kind of go through the cycle. But right now, the pacing model we have, our projection is that we would achieve the target allocations in 5 years. And so that is 2030. At that point, we have it maintaining that target allocation through the period. If you take a look at the last 5 years, so you take a look at the last 5 years of this chart, we're having to commit increasing amounts of capital just to maintain the current targets that we have. And so if we were to increase those, you would see this, go up much higher. It'd be much, much steeper. And then so why don't we'll go to the next page. So the next page is one last thing I also wanted to, because this is a question that was in the CIC, was we took a look at last year, and last year was kind of an outlier. You take a look at it. I mean, did we expose ourselves to vintage year risk? And turn the page, and you can see that we actually didn't. So essentially, this is by vintage year. So this is when funds begin investing. The previous page is the results of a model. This is reality. And this is what we don't have control over. But what you can see here is that a large part of the 2025 commitments will roll over to a subsequent year. But one thing is, we take a look at, the chart, we take a look at the column all the way on the right, and it's TBD. And so what that is those are commitments that have been approved, and they could be illegal, or we're just waiting for the manager to begin investing and begin making capital calls. Now this amount, you take a look at it, it's right now, it's $8 billion. And so, there's significant pent-up demand for our capital flows. Just to give you a little bit of context into this number, if we were to take a look here, let's see, where do I have it? Oh, here. Apologies.
And I'm sorry, it's getting hard to hear because of the noise that's coming from outside. Did you say that it did negatively impact us for vintage year or not impact us for vintage year?
So for vintage year risk, you can see that it's comparable to the previous year, so it's not an outlier from a vintage year perspective. And so it did not expose us to vintage year risk. Now, given that our level of commitment is so much higher than it's been in the past, that we are exposed to vintage year risk, but that is naturally being diversified over time. So in terms of this pent-up demand, this carry forward, if we take a look at this, this has so I took a look back 5 years ago, and this TBD amount was $1 billion, and so this is up 8x over the last 5 years. It's up 5x over the last 3 years. Now, the way that funds draw down capital, typically, and this is, I'm going to speak in general terms. Some will draw down capital a little more quickly based on strategy. Like, for example, private debt, you typically have a shorter fund life and a shorter investment period, and so they'll draw down capital a little more quickly. And then you have longer duration type strategies like real assets that have longer fund lives, longer investment periods. But generally, what you're looking at is 25% of the commitment will be drawn down per year for the first 3 years. So 75% of that commitment over that 3-year period, and then remaining drawdowns are kind of smaller and over time, to the extent where usually the total amount of your commitment that will get drawn down is usually in the low 90%, somewhere around there. So when we look at this TBD, if I would imagine that probably 2/3 of this will be 2026 vintage year. But essentially, you could look at, this would put demand using those contribution rates. This would be $2 billion over a 3-year period just from what we have here. Now, this doesn't take into account all these new commitments that we're making. Now, granted, some of those will probably spill over to subsequent vintage years, but probably half of them, certainly that's what we've seen. Half of them, the commitment year and the vintage year will be the same. So even though it's not reflected right now, and I know it's frustrating that despite our best efforts, we've been unable to achieve these target allocations, just realize, we're doing everything we can, and there's a lot of pent-up demand for our capital that isn't currently reflected in the net asset value. So now I'm on page 156. So here we're talking about contributions, and one of the things that, one of the things that we've experienced and certainly Don's seen in investment operations is contributions have lacked. Managers are putting, deploying capital more slowly. It's a difficult environment. And then the other thing we're finding is that, they're initially relying on subscription credit lines. Previously that was, we saw that a lot in private equity, but and Don can attest to it, we're seeing it across the board now. And
one of the things that I'll just add to that is, so not only has the capital deployment environment been difficult or challenging for some managers, and there's been additional reliance on the subscription line of credit. Another item that could be affecting when we make the commitment versus when our GPs are actually calling capital is just when we get into the fundraise. So if we're able to get great fee discounts by being as part of the first close, that it may still be another year of fundraising that until they get to final close. And so that can be another thing, again, outside of our control, where we're getting good fee economics on the front end by committing early, but that does then add length of time to when that fund may actually start drawing capital. And if you add that in addition to use of a subscription line, so they're making their capital investments via subscription, so they wait to draw capital from us to pay for that. For those investments until a later period of time, you combine those things together, and that's how you can end up with some of the figures that were mentioned before, that in very lengthy periods of time between when you make the commitment versus when that capital actually starts to get deployed, so that initial vintage year is there. So just one additional reason for why it can take a little longer, and usually it's not any one individual factor, it's some combination of those.
Right. And also, it's a difficult fundraising environment. Funds are having to stay into market longer. Most institutional investors don't have the benefit of the inflows. And so they essentially have to fund capital calls with distributions, and distributions, as we'll see as we go through the presentation, have been muted now for several years. It's a difficult exit environment. So that's also a contributing factor. When we take a look at contributions here, we see significantly larger amount of contributions kind of going forward. And this is despite them lagging. It's just a function of the higher commitment numbers that we've been making. Also, I want to point out that you take a look at the final 5 years of the look forward, and you see that increasing level of contributions. That's under the assumption that we're maintaining, not growing, maintaining those targets. So this, combined with what we saw previously with permanent funds and the distribution of beneficiaries, this is where we're looking at competition, for capital, not really competition for capital, I'm sorry, liquidity. So greater demand on liquidity. The next page, we have distributions. As I said, they've been subdued. We have higher interest rates, there's valuation gaps, and there's a backlog of unsold assets. And to the point where you're seeing some managers resorting to things like NAV loans. You're hearing about continuation vehicles. You're talking about retail channels, and they're really just exploring ways of being able to put money back into LPs' hands so that they can go ahead and make more commitments.
And one thing I'll note also on this chart here is, flipping back a few pages to when we're looking at inflows and outflows, right? So the net inflows from, say, oil and gas revenues we have coming in versus distributions to beneficiaries. in the tail end of the decade, we expect that to start to normalize and distributions to beneficiaries will exceed inflows coming into the fund. But that's right about the time when, at least according to our pacing models and current expectations, that distributions into our funds, distributions from managers and investments that we've been making, should then outweigh contribute or help to offset contributions that we're making to our managers. And so is the next slide the total cumulative net, or is it just
Two more slides.
2 more slides? Okay, we will get to showing you what that net impact is, but essentially by the time we start to normalize with our inflows and outflows is about the time that we should start seeing significant distributions to us. So from our managers in these investments that we're making now that are now matured and should be income producing for us, which will help in the liquidity picture.
So let's turn to the next page. So this is page 160, net cash flow. So let's take a look at net cash flow here. And I included the black dotted line, the total, just because sometimes it's a little difficult with the stack chart when you have numbers that are both negative and positive to ascertain kind of where those levels are. But what you saw here, so if we take a look at, the first, let's say 10 years, so from, 2011 to, let's say, 2021, right around that time, what we saw was, our portfolios generally were mature, and you see that where you're starting to take a look and you're looking at on an annual basis, you're seeing more distributions than you are capital calls. And so that's one indicator, because if you think about a private fund and you think about, that life cycle, right? You've basically got 3 parts. So you have the first part, which is the investment period, then you have the harvest period, and then you have the liquidation period. And so when you see something like this, where you have, distributions exceeding contributions, that's an indication that, that the portfolio as a whole is kind of, mature and towards those latter stages. And then the inflows exploded and resulting in significant increases in commitments, which we see here. And you're able to see, essentially just, becoming, deeper and deeper each year. And one thing to point out is, essentially, what we talked about in 2030 is when we've got ourselves achieving that target allocation. And then you take a look at what happens the next 5 years, and on an annual basis, you look at, it's all distributions right now. That's the projection. And that is also, as Dawn pointed out, that is at the same time when permanent fund distributions end up kind of flat to perhaps even going negative. And essentially, so talked a little bit about, kind of that difficult environment. And so with pacing, pacing isn't random, right? It's the result of a manager's behavior, and it's a function of the environment as well as, the terms of the fund. So essentially, if a distribution doesn't occur in 1 year, the likelihood it's going to occur over the next year increases, and that just keeps getting pushed down towards the end of the fund life, where there needs to be an exit, and there's going to be an exit. So it kind of, it increases that. And so, right now, one of the things that, kind of based on, I think the thing that's most helpful with pacing is historical analysis, particularly trend analysis. And these are illiquid funds. The assets are marked to model. They're only marked to market when a transaction occurs. And so, changes happen more slowly over time. And so trend analysis and taking a look at that is quite helpful. And so since this is a pattern that we've seen, you know, for several years now, this was an adjustment that we made in the model where the distribution rate, we took a more, I would say a more neutral stance, to where the model will assume that distributions are gonna be more back-end loaded. So we can let's turn to the next page. So the next page, we've got, just so next page, cumulative net cash flow. So this is page 161. This is essentially a depiction of the J curve. And so what we see here is that same period where we were looking at net cash flows, kind of that first 10 years, you see that, you know, that J, you know, the beginning of the J curve here, it kind of bottomed out, you know, in 2020, and that was where, you know, typically we would start that ascent upward. However, you know, the inflows came and our level of commitment increased significantly. And so all of those negative, you know, years of net cash flows on a cumulative basis essentially created a double dip in this J curve. And so you see that double dip kind of bottoming in 2030, which is right now where, you know, we project that the target allocations would be achieved. And then to maintain them, you see that that's where we start that upward ascent. And that was what we saw when we took a look at, you know, the net cash flows, and we saw the distributions being more back end loaded. And that's precisely the time where, you know, we saw the permanent fund net cash flows start to be flat to slightly negative. Now at that point, the assumption is that we're going to maintain target allocations. If the decision was made to increase them, we would probably see a triple dip, and we would see to where rather than turning up, bottoming out and turning upward, we would see them start a new decline from there. The next page goes over the NAV, as well as the target, which is the dotted black line. As I indicated, you know, the current model, we have the current projection is that the target allocation will get achieved in 5 years, then maintained through that period. And so we would be looking at, you know, an NAV in 2030. So if you're looking, let me just quantify that for you. So at the end of last year, our net asset value across the private asset classes was roughly 20 billion. The projection in 2030 that will be 50 billion. And the projection at the end of the 10-year period is that would be 69 billion. The next page shows our unfunded commitments. So in the 10-year, our 10-year look forward, the projection is that unfunded commitments will more than double during that period. And that will put more demand for liquidity. And to put that into context, so our unfunded commitment at the end of last year was 11 billion. We projected to be 14 billion in 2030, 23 billion in 2035. The next page shows our total exposure. So this is essentially the net asset value plus the unfunded commitment. And this really represents our full spectrum of risk, what we own today and what must be funded tomorrow. One thing to note is another component of this is recallable distributions. So recallable distributions are a GP's right to recall capital that was returned during the investment period. So if they make an investment and they're able to make a quick realization and they're still in that investment period, they would have the right to put that money back out to work. Now, that is already included in the unfunded commitment. So when we get a recallable distribution, that increases the unfunded commitment. And so when we are, when we do our manager concentration analysis, what we're doing is we're taking this, so essentially this is, the GP, total exposure, and dividing it by total plan assets. And that's where we get our concentration analysis that Don and I present. So that's the end of the presentation. Are there any questions? A lot of data.
We have, really important and dense set of materials. It looks like we have one question, at least so far, from Member Roman.
Just a couple of random questions. One is Rystad, what the world uses, are they the source of truth for like the Abu Dhabi Sovereign Wealth Fund, or?
I would hesitate to call any analytics firm a sole source of truth. They are one of the leaders in bottom-up energy analysis in that space. There are other big analytics leaders, but they are among the best and the most prominent. They're not, I wouldn't call them or any individual firm the best or a single source of truth, but it is a good source for us.
Okay. And then for the investment side of this, I understand we've sat in cash or it's a huge drag on the portfolio and a huge opportunity cost for New Mexico citizens and their residents. And like you pointed out, we won't always have this problem. Oil will run out, or whatever our inflows are coming from are finite. So it's critically important that we pay attention to this, because even though it's cash, it's still an investment decision.
Absolutely.
A lot of people say, well, we're just sitting in cash, but it's still a decision.
It is.
It's an investment decision. So and that leads back to these interim benchmarks that we're using for the 3 top portfolios. So and all of this leads so importantly to asset allocation discussions that I know SIO clerk you have on the agenda. I mean, this is so critical, what this analysis is, so thank you for it. It's really important. Could you give us a sense, SIO clerk, of what is going to be leading up to that discussion, whenever that is?
Yes, so Mr. Chair and Member Roman, the investment committee last week heard a presentation on drawdowns and how that could impact our AUM and our returns. We're going to follow that up with a presentation on how drawdowns could impact our distributions to beneficiaries, as well as our liquidity. We'll then also do a presentation on what our asset allocation looks like compared to our peers. And we'll both look at the traditional mix of peers, which is mostly pension funds, but we'll also dive into what does the asset allocation look like for endowments, since we are much more like an endowment. Then we'll also take a look, going into the asset allocation study, of what do we do with the swallow cash. There are a few options. There are both short-term options if we think that long-term these are reasonable targets for private markets, but we could also say those aren't reasonable targets given who we are, and we need to reevaluate what our targets should be. So there are a few options for what we do about that, and we'll present those options to the council along with the asset allocation study.
It bothers me a lot that a manager comes to us, we commit, and 3 years later, we're still not called. Something's wrong with that picture. And so I don't know if we go back, especially in a scenario in the investment world where so much has changed in a couple of years.
Yeah.
To your railroad example, and $8 trillion is floating out there for growth in asset class that we didn't own 5 years ago.
Right.
So if I don't know how we can prevent that from happening. We don't want to miss an opportunity to put money to work, but it's taken up our balance sheet, at least it's taken up our decision-making because we've allocated to a manager, hasn't called capital yet. And then if they haven't called after 3 years, they're gonna dribble in or the next 10. So That's a problem.
And Mr. Chair, Member Roman, that's something we're starting to take a look at. Dunn's group is starting to do a lot more monitoring on the back end of what's happening with our managers. And now, when we're looking each month internally at what we're bringing forward, we go back and take a look at how have these managers been calling capital? Because if they've been really delaying it, that's something we want to know before potentially moving forward with another investment. So I'd say that's something we're taking a much closer look at now than we ever have before.
Something else that we've talked about in the investment committee and Chair Bingaman has brought up, and I agree with, is when we have a huge correction, like we saw with this war, how do we catch up to our allocation with a place marker? You know, an exchange traded note that gets us, so we just don't sit and do nothing. You don't want to, and I know this is going to be part of the drawdown discussion. You don't sit and sell when things get bad, but you don't sit and do nothing, especially when you're short of the targets that we all agreed on. So how do we make a move without being traders, but how do we play catch up when the market presents an opportunity? Usually it's around short-term geopolitical risks.
We've had discussions internally about a lot of these things, but we're waiting for the new CIO to come in and have that discussion with her before proceeding. But those are things that we're closely monitoring and well aware of.
And I would just jump in on that point. I mean, if there is a manager who, we make a commitment and they make an investment and utilize a subscription line, right, rather than drawing our capital, I mean, in theory, that's to our benefit, right? Because then when our capital does go in, it then earns a higher IRR. In the meantime, we're getting paid there. But I think what that implies, we just need to commit more. We need to have more commitments if possible. Knowing that has been factored into the analysis, correct, in terms of the drawdown pacing has factored that in.
But if we had a manager come to us in 2023 and say, I am the manager in this space, we might preclude other managers from presenting to us because we think we're already covered.
Yeah.
And we're not.
Yeah.
So it's like whoever gets to us first gets our space in that sector. And meanwhile, there's other opportunities going on. So it's almost like who's ever getting to market first saying they have a capital raise.
Right.
Saying they have opportunities in a sector we want to be in, and then they don't call capital for 3 years. That's I think a real opportunity cost on multiple levels.
Yeah, I think for a lot of GPs, they didn't anticipate what has unfolded. And so I think they were probably overly optimistic. One thing I will say is, with this backlog, the numbers are alarming where eightfold over a period of time, things like that. It actually is starting to clear. And things are we're starting to see things loosen up and managers putting capital to risk, or putting capital to work. We are seeing that. It's just a function of last year was such a large year for us. Essentially, I think our pacing called for 6 billion and we did almost 10. And so, and a lot of that too is just, you make commitments towards the end of the year. It takes time to, do the legal negotiation. And so of course, you're going to have a different commitment year and vintage year. But when I take a look at, we drill into kind of that backlog, we're seeing much less of a look back period. So it's more, it's things that maybe are 3 years are the exception. And mostly it's kind of the previous year, and then still maybe a little bit that probably was committed towards the back end of the previous year.
So what it leads me to think is that when we're looking, especially on these private deals, that takes so much staff time, it takes so much time, whether you're putting 100 million or 400 million to work, that we need to bigger bite sizes within our investment policy statement with all the appropriate percentages of the deal itself and of the manager. But if we're going to go through all this work, we got to make bigger moves. We're just never going to catch up here.
Right.
Bigger bite sizes when we have the opportunity.
Yes.
So for the SDC today, maybe there was an opportunity to do 200 million, we did 100. I don't know. But that's what comes to mind is the same amount of steps, whether you put 100 million to work or 500 million. So if we really have this conviction that we do, make bigger moves. I don't know, Clark, what you.
And Mr. Chair, Member Roman, I've directed the team to specifically do that. That if we have high conviction in something that we're, high enough conviction that we're bringing it to you in the first place, let's try to maximize the amount that we can get into that fund. Sometimes it's not possible, either because they're almost done with the fundraising, there's not much capacity left, or occasionally it's a smaller fund but still a manager we really want to get in with the hopes of getting in additional fundraisers later with them. But we are making a specific push to try to do larger ticket deals to try to close that gap.
My last comment, I'm sorry, Mr. Chair, is that does the legislature see this analysis?
Literally, I was just gonna ask that, if
This is
appropriate
so
for 5 o'clock, yeah.
important that they see what the possibilities.
And
could
maybe
be.
not all the detail, but definitely the message about the
message.
10-year,
Right.
10-year outlook.
Right. And what it's based on.
Yes, yeah, Mr. Chair, members, Roman and Madam Land Commissioner, the legislature did see pieces of this. One thing that I talked to legislative committees about last year, both IPOC and House Appropriations and Finance, was the rapidly increasing commitment sizes, commitment deals, and what that meant for our staffing, because each of those deals takes a lot of work. It's the investment team doing it, but then it's also the rest of the office monitoring it on the back end, and it's the legal team negotiating the deals. And so it was very helpful for them to see what that gap is for between our targets and where we actually are, and recognizing that we need additional staffing, additional resources to be able to invest in the cash.
And Mr. Chair, and Commissioner, another thing that we do when we're our presentations to the legislature is understanding not just how, when we talk about fund growth, we're thinking on our end how we manage those assets, but at the end of the day, what it really matters is our distributions to our beneficiaries and how it impacts budgets. And so that's a big message that we focus on with the legislature, is how this will become our funding sources will become an increasingly important source of funding for the legislature and for a variety of different programs. It is not only funding education through like the land grant fund, but with the severance tax fund distributions, which are general government distributions. They can be used according to any kind of priority that the legislature has to just fund general budgets. That by 2050, we think that it will replace oil and gas as the third leg in the three-legged stool of revenues. That's a huge revenue replacement that wouldn't otherwise be possible by any other industry or any other type of economic development type of investments that we could be making. So we're able to help grow and offset some of those future changes in oil and gas, but not just that. The other individual funds that we're funding are also providing increasing amounts of benefits in things like the Opportunity Scholarship, which is a significant portion is funded by the Higher Education Fund, workforce development programs, et cetera. And so we try to, when we present to the legislature, couch this is not just about fund growth, because that's not the point. This is about distribution growth. This is about funding state government and
Stability.
how, and
I think it's about stability.
Exactly. And LFC did a volatility analysis in 2019. They recently updated it, I believe, in 2023 or 2024, showing that investment fund distributions are among the most stable sources of general fund revenue of all other sources. And one of the things that when we bring to you a distribution analysis in the event of an economic downturn, the GFC is a really good example of that. At a time when every other revenue source was declining, our distributions increased because they're based on a 5-year average, and that 5-year average had grown even though that single year saw very significant declines in the fund's value. Our distributions had increased. Now that's a liquidity management issue for us, and then we need to know what that looks like for us when we have increasing distributions at a time when you have a market downturn. But on the back end for budgets and for state government, that provides increasing stability. And once that 5-year average started to catch up, our distribution really started to kind of stabilize, decline just a little for over that 5 years. But by then, PIT had recovered, GRT had recovered, and we were still able to provide that stability. So looking at not just what the impact is to our funds, but the ultimate purpose, which is the impact to the beneficiaries.
And Mr. Chair, and to your point, Madam Land Commissioner, stability of the revenues, that 2024 report that Don referenced, it estimated that from 2019 to 2024, our distributions back to the state had, because of their growth and the stability of that growth, had taken out 38% of the state's revenue volatility in the general fund. And that's critically important since New Mexico has long been one of the 5 worst states in the country for revenue volatility. But what that report also said was it estimated that in the 5 years following 2024, our distributions back to the general fund would take out an additional 55% of revenue volatility. So we're going from one of the worst states in the country in terms of revenue volatility to, at worst, mid-pack and potentially headed towards one of the best states. And what I've been stressing in my presentations is this also now allows the state to engage in long-term planning in a way we never were able to before. Because if you don't know what your revenue is going to look like 2 years from now, how are you going to plan for where you want to be in 5 or 10 years? But now that we're able to provide much greater certainty to the state, the next governor is going to be able to do long-term planning in a way that no other governor has.
Good discussion. Additional questions, comments on the pacing analysis?
Thank you for it. Yeah.
So I also have, and this is something I discussed at the CIC meeting, but I have the individual asset class tear sheets.
Oh, wow. Yeah, that's.
So I printed these out for you. The colors, I know with these stacked, when you have a stacked chart, stacked columns, it's kind of hard to decipher exactly, what belongs to what. So I've got these one pagers, and then the colors align with what the colors that are using the stack chart, so you can just very easily kind of go back and forth and reference. But Joel's gonna hand these out, and then we can send them electronically to folks if they'd like to receive them as well.
Thank you. And yeah, before we close, I would also just say, if we continue to trail the targets, if in 2 years from now, we're still looking out another 5 years to hit our targets, hypothetically, right, depending on inflows, everything else. I think we should think about, listed alternatives, when the new CEO comes on and,
We've had interim targets, you being the council, since roughly 2010.
Yeah.
Yeah, that's, and that is one of the alternatives that we've talked about.
Yeah, in other words, getting exposure to some of these private asset classes through the stock market, recognizing there's more volatility, but rapidly, replicating some of that exposure.
And certainly with what and this kind of goes back a little bit to Mary, your question, and John was able to elaborate a little bit on the systems that we're looking to implement. So I gave you a little bit of context on, you talked about kind of that first phase. So our greatest need at that initially was private markets. And so we implemented MSCI's Private Eye platform, formerly known as Burgess, but MSCI purchased Burgess. Now that implementation has been substantially complete, and Joel is taking responsibility for that and maintaining it going forward. But essentially what it provides us is position level transparency into all of our funds. And so, just on that platform alone, we're looking at, 400 active funds and 10,000 underlying either companies or assets. And so, and this kind of goes beyond, just presenting the investment, but also you having confidence in our ability to monitor the investments that we've made, as well as manage that aggregate portfolio. So, give you confidence that when we come and we present a fund, the merits, we have the merits of the fund, but then also how that fund fits within the portfolio. And then ultimately, when we do this next phase, how that fits into the aggregate portfolio. So we'll be making decisions, based on multiple levels. But that's the next phase is focus on public markets and on the integration. And with the goal everyone on the investment team has best in class tools to help them within their area of responsibility, but then we will have something where we can have total portfolio attribution exposure and risk analysis on in one single platform.
Okay, and any questions, comments from the phone?
I did, Mr. Chairman.
Okay, Treasurer?
As it relates to all of the pacing that you did any of this factor in all of the other local governments that you also invest on behalf of?
Yes. Yeah, this takes into account, and this is why when, in the presentation, when I'm showing stacked, everything's stacked, I couldn't do anything with allocations. You'll see that on these individual ones because each asset class has different participants and they have different asset allocations. And so while I could do that in dollars, on an NAV basis in terms of, allocations, you'll see that on the individual sheets. So yeah, this accounts for all participants into each of the asset classes.
And Mr. Chairman, and or maybe SIO Clark, how many dollars are there right now just within the portfolio for the government entities?
That's $100 billion. In private assets. Yeah, Madam Treasurer, it's under $1 billion in private assets, but it's about $2.5 billion in total.
For those the 50.
Yes.
Yeah.
Mr. Chairman, I know that has increased dramatically just in the 3 years that I've been here. And I believe that now that more counties and cities are learning about SIC and what they're able to do, that number is going to jump up pretty quickly as well. So that's just something I wanted to make sure we were factoring in. And as we factor it in, if it's something that we have to do an analysis on as to whether or not we should be charging them to do so, we should do that as well. I know they pay the cost of whatever it is in their portfolio. But for example, with the LGIP, we charge 5 basis points. And so just something to put on your radar as well. Thank you.
Okay, thank you very much. Any additional comments, questions? Okay, let's, thank you very much for that discussion. Let's move on to finance matters and hear from the chair of our audit committee, Member Tejas. Still with us there.
Thank you, Mr. Chair and council members. We did meet yesterday in the audit committee. We did not have a quorum, but we did our best to discuss all the different issues that we're considering in the audit committee. The primary discussion really revolved around the audit committee charter, so we worked on that. The charter with red lines was presented to the committee, and we made a few revisions, and I understand that is nearing to be completed and will be presented to that full SIC in the near term. So that's where we spent most of our time, but we did discuss the FY27 preliminary budget, and our CFO, Brent Shipp, will talk about that a little bit here in a little bit. We reviewed our budget to actual comparisons and our investment holdings report. And that really covers it. So I'll turn it over to Brent to provide any additional commentary.
Mr. Chair, just a couple of schedules I'm going to touch upon, and I'll be done. I'm on page 252. This is the preliminary budget for fiscal year 27, which is due May 1st. Within this budget, you'll notice that the first column there, adjusted budget for fiscal year 26, $104 million. It's a little bit different to the budget schedule that we have included in the material through March, because I went ahead and included the pending FAR that is probably going to be approved within the next 5 days of $24 billion or $24 million that will get us through the end of the fiscal year. I also, within this schedule, indicated the appropriation request for fiscal year 27. As you know, there was some changes to that. which gets us to the approved appropriation, which we put together this fiscal year 27 adjusted budget. And I think we're probably set on that. The one thing that I came up with when I looked at the schedule, you might look and say, well, compared to the adjusted budget for fiscal year 26, it looks like we're short in fiscal year 27. And you might say, well, how are you going to navigate that? Just be aware, all agencies have the ability to do bars for at least 5% of the budget. Plus, we have additional bar authority for fiscal year 27 of $25 million, which will allow us to get through the fiscal year with no problems. With that said, I'm open to any questions that you might have. I also want to point out on the second or the next schedule, we have contracts above $250,000, which Amy helped prepare. And if you have any questions on that, but that expenditure is for a new website that we're getting designed, and we're really excited about that. And that's something to be looking forward to in the future. And I'm open for any questions that you might have.
Okay, any questions for CFO Ship? One question just on the professional services. I guess we requested about 90 million and they gave us 80 million, if I'm reading that correctly. You just talk about, and isn't that pretty formulaic, just around, you know, the fees are what they are, the assets are what they are, you know? I guess there's some growth estimates you have to factor in.
There is, and you know, I think typically within the request, we do 2 standard deviations from the mean, and there is a little bit of play within that. So typically, they've always, with rare exception, they've given us some latitude there, but they can cut it as long as we get the bar authority. Mr. Chairman, that's the key, because we can later go in and true up any shortfalls that we have. And if you recall, for fiscal year 26, the fiscal year that we're in, we actually did not have any bar authority going into the fiscal year other than the 5%. So during this past session, we not only addressed the bar authority for fiscal year 27, the new fiscal year that starts July 1st, but also the lack of bar authority outside of that 5% for fiscal year 26. So I think there was some misunderstanding within LFC and others, thinking that some of these management agreements were more fixed and not variable based. And that's not the case at all. I think they've been educated with the help of John, and hopefully going forward it'll be a little bit easier to navigate.
And Mr. Chair, LFC also has now assigned us a much more seasoned analyst. I think that'll also help us moving forward.
Okay, additional questions? Okay, hearing none, thank you for that report. We'll now move to closing matters. Any older new business or other informational items anyone has for us?
Mr. Chair, I just wanted to mention, I had never seen this before, on page 12 through 14 of our packet, the State Investment Officers Briefing. Maybe that's been in there and I just never focused on it, but I think it's really helpful. If you had to carry one thing with you, this would be it, about where we are, and all get asked individually questions all the time about the SIC, so.
Mr. Chair and Member Roman, we've improved that piece over the last couple of years. Really want to thank my team for putting that together.
Yeah, it's very helpful.
Okay, anything in addition to that? Okay, do we have any public comment today? Seeing senators join us, anyone else on the roster for today? Okay, Senator, please join us and adhere to our 5-minute policy, please.
I thought it was 10. It's 10 last week, anyway. 5 minutes is a lot of time in front of the SIC. You need to know that right now Georgia is getting all the film activity in the country. How are they doing that? Because they modeled their program after New Mexico. What happened? We got stuck with the word distribution contract. We let Mr. Kulka go. We got tied in with Bill Richardson's corruption and siphoning off of the State Investment Council about $300 million, which he gave to his pals so that they could give him a kickback. Why did the state choose to turn their back on the film industry and allow Georgia? I've been to Georgia. I spent a lot of time in Georgia. It's trees and rivers. High trees and rivers. You don't get to, there's no mountains. There's no land to shoot on. Why are they going there? Because they gave higher percentage of return on the gross receipts tax than we do. What's 40% of zero? It's zero. That's what we're doing now. We give 40% return on an investment in film in New Mexico. We have no activity. There's one film that's being shot here. You go to Georgia, oh, they'll give you 50%. Why? Because they know that 50% of something is a hell of a lot better than 40% of nothing. Now, you know, it's real easy to look at this and say, would I rather have a philosopher learn how to be an engineer, or would I rather spend time getting my engineers to learn philosophy? And what we've got here is I don't know the language for AI. I know the language for film. I don't know the language for, what do we do? Well, I'm not going to comment on what you just did, but I don't know what the language is for some of the things that we've subscribed to. However, I do know the language for art. I came in 3 months ago and I said, right now, if we gave $10 million to the Van Gogh Museum in Amsterdam, we would make national headlines. They could give us a piece of art, which was in the bill that I passed twice. The last time I passed it and it didn't get vetoed, it was because the SIC came and told Governor Richardson, you know what, we don't need legislation to get investment into art. That's what you said. That was your opinion. So I didn't have to pass the law again. And you know what? You've turned your back on film. We now have, we just closed a sound stage down in Las Cruces. You've got hundreds of young people graduating from film school all across the state. There are no jobs in New Mexico. You know what we need to tell them? Go to Georgia. Go to Rhode Island. What kind of an investment strategy is that? When right now every provider of equipment in New Mexico to the film industry is bankrupt. Is that the message we give the film industry? Well, that's the message we're doing now. We're like Scrooge McDuck. He's got a vault full of money, but he doesn't recognize the ducklings that come to him and say, gee, I just got a film degree. What do I do with it? Please help. Do I hire Mercer? Do I come in with a group of art producers and art museums that can then show you how an investment in art would be phenomenal for New Mexico? You could have given $10 million to the Louvre Museum and you might have gotten Salvador Dali's Last Supper. And we could hold here for about 3 or 4 months as collateral on our loan, and guess how many people all over the world would come back to our museums. I'm urging you, it's now my time is up, and I'll be back again. Next time I come back, I'm going to come back with a portfolio, with Mercer sitting next to me, and a whole bunch of people from the art community and the film community that can show you how we can make money for you. Thank you very much.
Thank you.
Chairman, I appreciate your time, and I know I just cut into everybody's lunch time. Thank you very much for that. That's precious.
All right, thank you very much for that public comment. And with that, looks like our next meeting is Tuesday, May 26th, same time, same place. Is there a motion to adjourn?
So moved.
So moved.
We are adjourned. Thank you very much.
Have a great week, everyone.
Thank you.